All right. Good morning, good afternoon, good evening, wherever you are. We are live for SOFI's earnings. I think are they releasing it? Is the call at 7:30 or are they releasing the results at 7:30? Let me just take a look. I remember the timing was around 7:30, is it? Oh, okay. Results are out. Very quickly, let us just pull up the results and let's see how they've done. And as we go on, what I'm going to do is we are going to put this into our spreadsheet as well to see how that affects the valuation. All right, let me share my screen. I think I got it over here. So this is their earnings presentation, $1.2 billion. I believe that is in the ballpark of what we estimated. I think we were at 1.91 or something, $1.96 billion. So 1.2 is more or less in that ballpark. Okay, my internet is not cooperating with me right now. SOFI is down 2% in the pre-markets. All right, I wonder what is that about. Hi, good evening, Kunal. Let's see, delivering. All right, let's take a look. Do they have the... So if you take a look at the presentation, let's see where they are. Unaided brand awareness up 10.4%. Total numbers 15.8 million. Where does that stand compared to our... Let's see where this stands. Our member projection is 15.78. So slightly more than what we expected. 15.814. This is basically, yeah, adding in 1.1 million members. Wow. Okay, so growth was actually pretty strong over here. This meant that on a quarter-over-quarter basis, 7.8%, year-over-year basis, 34.6%. So exactly more or less in that ballpark of what we expected. I think that's why revenue came in high as well. Let's see, rule of 40, okay, not that 70. Adjusted net revenue. Oh, this is giving you a 30% CAGR, okay. Right, so this is the adjusted net revenue in billions of dollars. The slides change a little bit, right? So the path to okay, this is new. Oh, sorry, I just realized I'm still sharing my... Good morning, Kevin. I just realized I'm still sharing my... Okay, well, the drop is not that severe now. We're just down 0.7%. I believe this is a new slide. Right, so they are basically showing you how they think about return on tangible common equity. Net income divided by adjusted net revenue times adjusted net revenue divided by, okay, average tangible common equity. Initiatives to fuel continued durable growth. So they have SoFi Crypto, SoFi Pay, SoFi USD, Big Business Banking, SoFi Coach, SoFi Technology Solutions. I think what is interesting for... I think for me, what is interesting is going to be listening to the earnings call and see what management has to say. In the pre-markets, now we are back down below 2%. So let's see products, 24.3 million. So we are a little bit light on our products. Actually, products came in much stronger. 24.38 million. Let me just change this and then I'll show you how that actually... Give me a minute. And basically, if I take total number of products divided by the total number of members, we are basically 1.54 products per member. Wow. Okay. So fundamentally, we can see that they are improving. I'm gonna unshare this so that we can go into the spreadsheet for a moment. I'm filling up the spreadsheet as we are walking through this so that we can see how it affects the valuation later on. But right now, what we are seeing over here, 15.8 total members, and then basically with the total products at 24.38, this actually puts us at a total products per member of close to 1.55. So we are around 1.54, right? So 1.54 is actually a very healthy range to be in. We are looking at getting this closer to 2. So that means I'm likely assuming 1.55 in 2020 in Q3. But I think so far, strong start. Don't see why we are down 2% yet. They're executing and stable. I think the market is just punishing it for coming in line with expectations. I'm not sure. It might be a guidance thing. But down 2% today, I think it's much better than where we were in the last quarter. Last quarter, we were down, 9% on the report. So I have no qualms with their report over here. Let's go through the entire report first, then we'll fill it in. Uh, we'll fill it in later. Okay, so with that durable growth, adjusted net revenue, adjusted EBITDA, 1.206. Cash revenue is basically 100%. So I think this means that 100% of revenue is cash, right? So this is interesting. Adjusted net revenue over here, fee-based revenue mix. So again, we are seeing this decline over here, where last quarter we had around 43% in Q2 of 2026. No. Oh, this is Q2 2026. Let's see. Fee-based revenue annualized. So I mean, at the end of the day, we are still expecting annualized fee-based revenue to come in higher in 2026 than in 2025. Their slides have changed a little bit, right? Am I mistaken? $1.2 billion in adjusted net revenue. This is basically in line with what we expected. We are around, our expectation was 1.99. So this is really much in line with what we expected. Adjusted EBITDA, let's take a look. Adjusted EBITDA, we are at 370. So this is okay, slightly, I mean, in that ballpark. Everything is all more or less in that ballpark. And adjusted net income, $160 million. $160 million is, around that 14 cents EPS. Yeah, of course. I mean, this is negative 1% is better than uh than a negative 1% is better than negative 9%. Of course, we would all prefer it if we actually saw the expected move of plus 9%. Good morning, as I expected. Good company, bad stock. I mean, I don't think it's a bad stock. I mean, okay, at least I can't call it a bad stock because I've been sitting in this from $7. So, and I already took profits at 28. So it's like that's like a 4x for me. So now I'm just sitting on the remaining position. So I can't in good conscience it has been a bad stock for me. I guess it has been a bad stock if you have just invested in the last 12 months. But if you have been following SOFI from 2022, this has been pretty decent. Definitely much better in the 30s. But I mean, yeah, I think it's all right. We are seeing right now that the rate equation getting priced into SOFI. And I think SOFI is just doing what SOFI does. It's not an extraordinary quarter, it's a strong quarter, which they always give us strong quarters. So I really have no qualms over here. I think the only thing for me is that I think at the end of the day, when you are SOFI, you are a bank that has a technology platform. People expect slightly different things from you. If you're doing a strong banking quarter, then you are going to get hit when the tech platform doesn't really show. I just want to look at, okay, I prefer looking at this because I can see everything clearly. Okay, yes, this was the one I'm looking for. All right, so cross buy continue to accelerate up to 51% of new products. Why is this important? Because if you remember in my SOFI video, I was talking about SOFI Plus that has accelerated cross buy to 43%. This was as of May of 2026 based on Anthony Nodo's interview at the JP Morgan conference. And so to reach 51% in June, I think it shows even greater adoption of SOFI Plus. This is up from 43% last quarter, right? So durable net revenue, okay, 1.4 billion. EBITDA, around $560 million. That's fine. Okay, rule of 40, score of 70, also very good. Deepening relation. Okay, so we have surpassed 200,000 paid SOFI Plus members after relaunching the premium membership. And Anthony Nodo said the aim is around 1 million members by the end of 2027, right? In 2 years. So this is much stronger than what we had last year, because last year SOFI Plus throughout the entire year only had 60,000 members. So to get 200,000 members in just the space of, call it what, 2 months? Is it 2 months? 1st April they relaunched it. So 3 months throughout the entire quarter, you basically tripled your adoption within a quarter, compared to what you did the entirety of 2025. So I think this actually shows that the adoption is pretty strong. If we can add 200,000 SOFI Plus members every single quarter, even 150,000 SOFI Plus members every single quarter, we are looking at them getting to 1 million SOFI Plus members by sometime in the second quarter of 2027. And with 51% additional cross buy, think about it, 50 out of this new 1 million members, that's additional at least 500 to 600,000 new products being added on. And all of these are higher margin products because they did not have to pay a second customer acquisition cost in order to acquire the customer. Customer is already on their ecosystem. In fact, they are paying so far an additional $10 to be able to access some of these advantages. So for me, I am not too, I'm definitely happy with this. Let's see. So I think if you ask me, I really like what I'm seeing so far. I don't see why we are down 3% now. We are down 3%. Yes, we are down 3%. No idea why. All right, give me a minute. Something is wrong with my StreamYard settings, I think. Okay, anyway, let's go through the rest of it first. Record loan originations. We also expected loan origination. Oh, wow. Loan originations of $14.8 billion. We were expecting around $13 billion. 14.8 is much higher than what we expected. So we already know that this is to fund growth in other areas, expanding innovation. This is fine. Strengthening brand awareness. Okay. Second quarter fee-based revenue for $472 million. This is fine. $1.2 billion, 43%. So it's a 43% year-over-year growth, is it? Okay, wow. I think we were expecting 40%. 43 is fantastic. Net interest income, $788 million, up 52%. Okay, let's see the breakdown. Record 1.1 million members, bringing total members up to 15.8 million. Fantastic. Let's see. Products per segment. Okay, so lending products came in at 3 million lending products. What was our assumption? I think our assumption was just under 3, around in that ballpark, right? Because we expected slightly lower. Yeah, I think we expected slightly lower total products. That's why we are seeing this number. And 21,288. Okay, fantastic. So there's not much change over here. I think they're pretty consistent. Actually, what I noticed is that SOFI has not uh, increased the total number of products, lending products, by that in terms of the growth, right? It wasn't that significant in terms of increasing the total lending products as a percentage of overall products that were sold in this quarter. What actually happened is that they were able to better monetize their lending products. So that's fantastic. Tech platform accounts, we are seeing 135 million accounts. So again, some people were saying that my expectations for the tech platform might have been a little bit bearish. They are going to start to reaccelerate very quickly. But again, if you have been invested in SoFi for an extremely long period of time, you know that the only segment that they tend to not have a good grasp of their business is the tech platform. Now, I'm going to show you over here in my own uh, assumptions. I was actually expecting 137. Where's my tech platform? 137 million accounts. So we are getting 135 million accounts over here. Let's put this. Whoops. 135 million accounts. So that's an additional 2 million accounts. Like I said, I think the scaling of the tech platform, it's going to be number one, much slower than we expected. Number two, we are only seeing the effects of SoFi stablecoin and the big business banking come in 1st July onwards, because that's when the API actually goes live for them to connect onto SoFi's tech stack. So I believe perhaps second half of 2026, we might see a little bit more acceleration there. Okay, financial services product, this is fine. I just want to see the actual results. Okay, financial services segment net revenue of $466.3 million. So segment revenue. That's actually much lower than I expected. So this, I think this is probably why it is I think this is probably why the markets are punishing SoFi. Financial services are coming in at $466 million. Even for my own assumption, I was expecting them to come in much higher because I thought they will be able to maintain their 40% year-over-year growth guidance. But that also means that it is very likely that in the back half of 2026, they are going to significantly accelerate this amount, because on a blended growth rate, they are somewhere around 33, 34%. And the guidance for the full year is actually 40%. And I don't think they are going to miss their financial services revenue growth guidance. I think right now what we are seeing is the effects of their focus on lending revenue, right? So let me just fill this in. Because our loan originations expectation was $13.2 billion, which is why I expected a little bit more for financial services, but we actually got a huge beat in the loan originations over here. Loan platform business added. Okay, so if later on we will be taking a look at the nuance of the numbers over here, I just want to just talk through it as we wait for the earnings call. It's what? I think 7:30, right? So it's soon. Loan platform business, $143 million. Okay, so later on, I will take a look at this number uh, as a percentage of uh, overall revenue. Let me just, where is my, okay, I am in the waiting. Okay, I'm just putting myself into the waiting room so that I will know when they actually go live. Oh, 8 p.m. So we still have about an hour or so to go, right? Okay, so we have time to actually play with the numbers a little bit more than I expected over here. Okay, let's go through first. Loan platform business basically did $3.1 billion of originations. Contribution profit 212 million, 46% margin. I think the margins is fine because last quarter they did 45, so it's very much in line. I think right now the problem with SOFI is that we are not sure what management was going to do this quarter. Yes, of course, also everyone is waiting for FOMC. I just hope they don't come out and be overly conservative in terms of their guidance, in terms of their commentary. Uh, Otherwise, it's going to spook investors even more. Okay, later on, I'll take a look at the individual breakdown over here. But one thing that jumps out to me immediately is the SoFi Invest number. I believe I didn't even expect 38%. I was expecting in the low 30% growth. So that's strong. In terms of crypto, we added total products is 388,000. I don't think the crypto side is actually growing as fast as I thought it would. I believe my expectations for crypto was closer to around 400,000, 420,000 products, slightly lower than what I expected. SoFi Plus, so this has become a new line item, right? This is a new line item. You have SoFi Plus, 206,000 new members at work. This is fine. Okay, technology segment net revenue of $84.5 million. Did I get it correct in the first place? What was my expectations for the tech platform segment? I was at 82. So in terms of the ability to monetize the tech platform, okay, this actually came in better than I expected. So at 84.5, later on you'll see as I talk through this, it's around 63 cents of revenue per Galileo account. Okay, at least it's no longer 57 cents, but we are also not near to the highs of around 70 cents. 72 cents was the highest, right? This was back in 2022. So we want to see this trend, the unit economics for the Galileo account continue to trend upwards a little bit. Let's see, technology platform decreased 16% year over year. That has to do with Chime, not a concern over here. Okay, lending gap net revenue of $724 million. This is definitely much higher than what I expected. My expectations for lending revenue were $650 million. And I already thought that was a little bit bullish. So to be $724.8 million is definitely much higher than I expected. And I believe what the loan originations was $14.8 billion. So in terms of loan originations, we grew originations by 68, 69% on a year-over-year basis. In terms of, sorry, where is this? In terms of lending growth, we grew at 62% on a year-over-year basis. So they beat definitely on lending. And I think, yeah, people are just worried about FOMC. That's all I can say. There's nothing bad over here. Even if you want to price it in as a very strong growing bank, then it is a very strong growing bank, right? Even if you discount the tech platform completely. Adjusted net revenue of 711.7. Okay, so 711.7. So you're around 59%. Sorry. Okay. Look at this. This is fantastic growth over here. Contribution profit margins around 55%. I think that's very strong. I think usually when they optimize their lending platform, the margins are in the mid 50%. This is perfectly fine. Okay. These are the fair value of their loans. Yeah, I think it's fine. I really have no problems with whatever they are reporting. Let's see. Weighted average coupon. Weighted average coupon come down. Annual default rate is around there. Maybe this is something that spook markets up by a little bit. Conditional prepayment rate, weighted average discount rate, benchmark rate. That's fine. So let's see. For the second quarter, record originations $14.8 billion, up 69% year over year. Record personal loan originations of $10.7 billion in the second quarter. So personal loan originations, $10.7 billion. So that's a 72% of total originations. Okay. Student loan volume of $2.7 billion was up 170% year over year. Wow. Student loan originations 270. I mean, growth on a growth basis, this is definitely impressive. You are at 900 million last year. Right now we are at 200. So we nearly 3x the value of the loan platform business. Not loan platform, the student loan originations. Wow. Home loan 1.4 billion, up 74% year over year. Okay. I think home loans we are more or less in line with that kind of expectations. I'll key in the exact numbers later on, but this is what we have for now. Okay, fantastic. Okay. Capital markets activity was strong. Overall, SOFI sold transfer through our loan platform business more than $4.1 billion in personal loans and home loans. In terms of home loans, blended execution of 0.16%. This is fine. SOFI's home loans, they don't really hold it on the balance sheet in general. It's around that kind of margins. Two co-contributed securitization of loans previously originated through our loan platform business total $1.4 billion. So this is what we were talking about in the video. So they don't just help to issue personal loans, they also help to through the loan platform business, they help to securitize the loans issued out through the loan platform business as well. So this marks the 6th and 7th securitization of new collateral under the SOFI consumer loan program, using collateral originated in the loan platform business, right? So this is fine. The transaction price, industry leading cost of funds level with a weighted average spread of 91 basis points and 86 basis points. So you are seeing that in terms of capital markets, at least the region that SOFI is operating in, it is not as affected as some people may seem. I think right now there are a lot of fears around capital markets. Oh my goodness, capital market activities. But SOFI is definitely not seeing that as well. Credit performance for personal loans in line with expectations. The all-in annualized charge-off rates would have been 3.7%. This is very low, right? 70 basis points improvement from the prior quarter. But this is including the charge-offs, including the charge-off, right? The all-in annualized charge-off rate for personal would have been, including recoveries. Okay, excluding, sorry, I misread it. Excluding the late stage delinquent loans, we're at 3.7%. Okay, I thought including we're at 3.7. That's a big jump. Personal loans charge-off decreased to 21 basis points to 2.6%. Impact of asset sales, new originated delinquency sales charge-off rates decreased from this. Okay. Student loans charge-off decreased 61 basis points from 65 basis points prior quarter. On balance sheets, 90-day delinquency rates for both personal and student loans were consistent prior year. Fine. Data continues to accept. Okay. So in terms of their loan vintage, we are not concerned, right? They've always been aiming for 7 to 8%, and we are trending below that. So real vintages, net cumulative loss of 4.8%, 4.6%, well below the. Okay, so you see, in terms of loan or loan vintage, we are expected to be around 6.4, currently trending at 4.6. So I don't think there is any worry about SoFi's balance sheet, even if we do go into a recession. I think one of the main concerns, sorry, let me adjust myself. I think one of the main concerns when you are investing in SoFi is what happens if the higher oil prices continue and then the Fed is stuck between a rock and a hard place. They have to raise interest rates to prevent higher oil prices from causing inflation. Yet at the same time, the economy is not really as strong as we think it is, because we are seeing quite a bit of tech layoffs. I believe the recent report that I've seen is that the amount of tech layoffs year to date up to what, July or June, I can't remember when was that report released, is basically already above the entirety of the layoffs in 2025. Okay, so the drop off for SoFi is accelerating. Now we are down 5%. But like I said, I don't think I'm too concerned with what happens in the pre-market, because we have seen previously before, sometimes SoFi can be down in the pre-markets and then absolutely rocket up later on. And and thankfully, I was a little bit greedy with my covered calls. I have covered calls expiring next Friday on the 7th of August at $23. And for 13,000 shares, you get about $4,000. I think that's a pretty uh, good place to be. So I think right now, I am going to say that based on the results, I don't think SoFi breaks $20 in the third quarter, unless they come out and they say something drastic during their earnings call. But just looking at this, if SoFi continues to chug along, then I think the fair value, according to the markets, not to me, according to the markets, will be, yeah, within this range. So I did buy some leaps on SoFi yesterday for 2028. And the reason for that is that because I'm not sure what kind of quarter that they would put up. So the reason why I bought the leaps is because in case they blew us out of the water, I would have been able to get at a lower price. But in a scenario like this where they did not blow us out of the water, they just gave good results, I would be able to buy even more today. So I am basically, and it's not many. It's probably like 20 to 30 leaps. So that's like, I bought 10 yesterday. I plan to increase that position to maybe 20 to 30 leaps. So we are talking about like $18 or so into SoFi, so that and I do believe that by 2028 December everything will be fine and it will be above $18 because my strike is at $18. And if you ask me, do I think we will be above $18 by December 2028? Yes. Do I think we'll be above $24, which is the break-even price? I also think my answer to that would be yes. So let's continue. Okay, so I got the exact numbers. Fantastic. I want the exact number so I can key this in. All right. I'm gonna talk you guys through the numbers right now, and let's see where we end up. So I'm gonna be sharing the spreadsheet. Let's try and find the exact numbers starting from the total members over here. I believe total members we have already got it right. Do we have total members? Yeah. 15.814. This is the exact number. Net new members, 1.1 million. Lending products, already got it. I believe I've gotten everything in. Yes. Okay, this is all correct. Let me just double confirm this plus this. Sorry. Yep, 24381. Okay. So this actually puts us at hmm, what's with this? Oh, okay. Financial. Okay, that's fine. 1.54. Okay, lending revenue per product. This is where I will just have to drag this across. So we are actually seeing lending revenue per product come in at $230. And I think the disappointment is in financial services over here. This is around $22. Okay, so this is where we stand in terms of SOFI's key metrics. Lending revenue much higher than expected, $230 of lending revenue per product. Financial services revenue per product in line with last quarter at $22. Now, total deposits. Did they give us total deposits? Let me see total deposits. Okay, in the second quarter of 2026, total deposits grew $5.3 billion, wow, to $45 billion. Okay, okay, wow. 45416. So the number, oh wow, this is a huge increase, right, in terms of total deposits. Sorry, let me adjust my screen so that you guys can see. So this is 45. Sorry, what's the number? 45416. So this is a 53% year-over-year growth in terms of the total deposits, and deposits per member has increased to 2,800, close to 2,900. And I think this is a very strong performance. I think this also largely is driven by a lot of the new products they have. They have increased their adoption of SOFI Invest, that is growing at 38%. And then we're also seeing crypto come on board at a very fast pace. They grew 75%, I believe, on a quarter-over-quarter basis, around there. So it will probably close at 16, since that's where my puts are. Yep. So I think, I think going into earnings, if you have held the company for a long enough period of time, it's always decent to get a little bit of protection. I mean, Lawrence's way is to always buy puts. For me, I like to sell covered call. Either way works, right? You do you. So that's where we are in deposit growth. Okay, let's look at the actual numbers over here. SoFi Money, we are at 7,888. So that's a 34% year-over-year growth. Okay, which is what management reported. This SoFi Invest 3,931.7. So we are at around a 38% year-over-year growth. Okay, fantastic. This is what, in terms of decimal place, you can put this to 3 or 4. Okay, credit card. Oh, I think this was the important one, right? Because last quarter they barely grew credit cards. Credit cards has re-accelerated, 509,000 credit cards. That is good. We are seeing this as a 48% year-over-year growth. Referred loans 180. So in the ballpark, that's fine. Crypto 388. 388.3. So I think, on at least for crypto, right? Let's just, for now, since it's still a relatively new line item, let's measure it on a quarter-over-quarter basis. So on a quarter-over-quarter basis, this is actually growing at 62%. So at least we have something to do our projections by in future. I wouldn't consider Q4 to Q1 as the first quarter, because very simply in Q4 to Q1, actually what we saw was that that was the real start of the crypto. Yes, they got some initial onboarding in Q4 2025, but that was only for, I believe, around 9 days. So the first full quarter was actually Q1 2026. And right now we are seeing around 62% growth on a quarter over quarter basis. I am perfectly fine with that. SoFi at work 189.1. SoFi Relay 799. Okay. SoFi Relay 7993. So what? Oops, sorry, 7993. So what is actually new is that they have added in. They have actually added in, I believe, SOFI Plus. So let me get this in. SOFI Plus. We do not really have numbers for adoption in the last couple of years, but let's see how this grows on a quarter-over-quarter basis, because this is the first time we actually have this number being reported. Let me just gray this out. Uh, and then we are at 206. This is fine. 0. Okay, it's not 0, but I don't have the exact numbers for the last couple of quarters. So I think I need to sum this as well. And I think we 21.8. Are we? Yeah, 21.28, 21.286. Okay, we are, you can see there's some rounding error, but we are more or less in that ballpark. I will go in and drill down the exact numbers. Give me a minute. Let me just, I have OCD. I need to get the exact numbers over here. You got calls so to offset the cost. Yeah, that's fantastic. All right, give me a second. Let me just where am I? Okay, I think it's rounding error, which is why I'm getting 2,000 less products over here. For some reason, I have OCD, so I need to go and find where's my 2 less products. Give me a minute. 7,888.4. This is okay. 3,931.72. If I want to be very very anal with this. Credit cards 509.8. So does that bring us up close? 509.8, so it's 510. Referred loans, we are 108.4. 180.4. Yeah, okay. See, all the decimal places actually matter. Crypto 388.3, that's fine. 208, 189.1. And SOFI relay 3993.8. I need this to be 0.8. And we are there. Okay, so this is the exact number. Everything matches. I think it's the decimal place, some of the rounding errors, which caused this. So far is down nearly 5% on the day. I am not too fussed by this. I think if we can, I mean, down 5% is not that bad. This is not coping, I can assure you. Let me take a look, because $16 is basically right at the 0.618 line. That's a line that we like to use as support. Failing, I think if we had gotten a worse report, we would have seen SOFI all the way down at $15, which was where we were trending to last earnings. But right now, I think this 5% move down on the day is okay. I can in fact even see us bouncing back across the next couple of weeks, because sometimes with SOFI, what happens is that on the earnings itself, it falls. But then as the market takes time to digest SOFI's earnings, they tend to be a little bit more excited. I would think that Robinhood, this after market close, would be good earnings as well. I'm going to be streaming Robinhood's earnings later on, so that we can compare between Robinhood and SOFI. And at the same time, we also have Meta, Microsoft tonight. So I will be on at market close, or at least close to market close. I am deciding whether or not I want to be streaming the FOMC. It depends, I think. I just realized that because I live in Singapore, I do not have access to YouTube TV. So I can't exactly share my CNBC stream because I'm getting my CNBC stream directly from CNBC themselves. So yeah, it's a little bit hard to stream that. Okay, so that is the key business metrics on the loan originations. Let's take a look at the actual numbers. Okay, personal loan originations, we are at 10,781.4. 359. This is the exact number. Student loan originations 2686 760 1393 375. So if I were to sum up everything, we should get the correct total loan originations. Yeah, fantastic. Okay. Yeah. Fantastic stuff. Right. So from here, we have grown total originations by around 69%. Personal loan originations per member 677. Student loan originations 170, in that ballpark from last quarter. So you can see that this was just a very strong lending quarter. And when you have a really strong lending quarter, and you also have, I need to hit the gym, but that's an idea. Yeah, if you have a very strong lending quarter and people are worried about rates, you can actually see why the stock is down, right? The revenue mix has got to shift. Later on, we'll take a look at the graph. I just want to make sure all the numbers are right first. In terms of adjusted net revenue for lending, adjusted net revenue for lending 711,672. 711,672. So that is around 48% of total originations, 59% year-over-year growth. What is the contribution profit over here? 399,033. So this means that it was a 56%. Yeah. This was a 56% contribution margin. Yes. Yes, 56% contribution margin. Yeah, 312. Okay, so everything works out fine down here. Financial services. Okay, this is the slightly disappointing one. 466,278. 466,278. One of the reasons why I say I found this disappointing is because they did tell us that based on contractual obligations, they should be able to maintain 40% year-over-year growth. But I think that could mean like throughout the year. That's number one. Number two, some of their contractual obligations I think run differently. So certain contracts may end in Q2, certain contracts come online in Q3. So they are likely giving us the aggregate number through the whole year. We will pay attention to this. This is not too far off from what they did last year. So if you take a look at financial services revenue, I just take the sum of the entire 2025, you get, oops, turn this into dollars. You get $1.5 billion. So right now, you are basically short of this minus the last two. So you are looking at financial services revenue of $320 billion to match what you did last year. You want a 40% growth, you need to times 1.4. So you are basically looking at around $600,000 of financial services revenue next 2 quarters in order to hit that number. If you're expecting 40% year-over-year growth, 50%, you're looking at 710 million, not thousand, sorry, $1 million. So can they do $630 million? Definitely. You can see over here, in order for them to do They just need to grow at around 52%. That's my assumption for the rest of the year, and you can get there quite comfortably. So I'm not saying that this is definitely not possible. It's something that we just need to keep an eye on. Okay, so that is financial services contribution profit 212,676. So if I take this as a margin, margins came in more or less in line, around 46%. And this is, yeah, automatically calculated. Tech platform revenue. Tech platform revenue is 84 million. Where is it? I just lost the number. I just saw it and I lost 84 million 505. So 84,505. We are 8 minutes away from the earnings. Am I right? Okay, it's still music now. So I will come back to it when it's no longer music. Okay, I'll come back to it when it's no longer music. Let's fill in the rest of this. Tech platform contribution profit. What is the tech platform contribution profit over here? We have 11,772,000. So margins actually got worse. Yikes. Like I said, Q3 2026. This is the first full quarter starting on 1st July, where we are getting SOFI technology platforms as a whole, right? So perhaps because of that, we are going to see better numbers in the second half of the year. Total Galileo accounts 101. Okay, the exact number is 1348041. Wow, okay. So it's even lesser than 2 million accounts added this quarter on a year-over-year basis. That is a 15% decline. Am I right? Oh, no, I'm not. This needs to be a formula. Whoops. This needs to be a formula over here. This still brings in around 63 cents of tech platform revenue per product. Corporate revenue. What was corporate revenue over here? Am I blind? Corporate. Where is corporate? Corporate other segment $56.9 million. Okay, $56.9 billion. 56905. Something is wrong here. Oh, sorry. 905. There's an additional one. Yep. So we are at $102.6 billion. Okay, this is exactly where we ended up. This is 40.5, 40% year-over-year growth. Fantastic. All right. So strong numbers, 40% year-over-year growth. If I put this number here, adjusted EBITDA, we are at how much is adjusted EBITDA? Adjusted EBITDA 357,821. Revenue up, EPS guidance same. Okay, I don't think, okay, technically that means margin takes a hit, but it depends on the assumption. If they come out and they tell us now our base case assumption is one rate hike and we're still keeping everything the same, then that is actually a bullish thing, at least to me. If you're expecting one rate hike, technically you should take a hit on your margins. But if you're keeping, so they're putting up the same EPS, but they're able to find other growth levers. And Anthony Nono did mention this on the Basis Points podcast that, this could be a year where because of the macro environment they're in, they may find other levers of growth. And if they find other levers of growth, that would mean that perhaps they grow revenue faster than expected, but bring in slightly less profitability. So yes, it does mean that, revenue guidance up, EPS guidance same. Technically, it is a margin compression. But at the same time, you also have to understand that at the start of the year, we were expecting 2 rate cuts. Right now, we're expecting 0. And the markets are even pricing in potentially 1 rate hike. If you see that ridiculous article by Citadel yesterday, I think yesterday they put out this article where they expected Kevin Walsh to actually hike rates tonight, a surprise hike. I really do not think that is. Let's just put it this way: I don't think Kevin Walsh is stupid. Like, it doesn't warrant a rate hike. The environment right now does not warrant a rate hike. So adjusted EBITDA on a year-over-year basis, we grew 43%. In terms of the adjusted EBITDA margins, we are at around 30%. So you can see they're actually I feel like they're directing their profitability to go back and grow the business. Net income, we are expecting. What is the net income number? Net income, oh crap, this is the 156,592. So in terms of a net income margin, that is a 13% net income margin. Okay. But again, this quarter is usually, not usually, this quarter is something that they have already warned us before. They warned us in Q4, they warned us in Q1, expected lower earnings than expected because of tax implications. So let me take a look. Okay, this is the full year. Full year is fine. All right, so rule of 40, 70, change in revenue. Okay, let's see, change in adjusted EBITDA. Okay, so let's take a look at the numbers over here. So they were actually operating the business at a 31% incremental EBITDA margins. Okay, that is so. This is where I say that SOFI is a very strange company in a sense that sometimes they have these levers that they can pull. They can choose to grow their profitability literally at the snap of their finger. And right now you can see the reason why they are unprofitable. Okay, the call is up. Let me bring up the call and we'll go through this later on.
Followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star
Sorry.
followed by the number 1 again. Thank you.
Okay, I'm going to
With
mute
that,
myself. If you
you
got
may
any
begin your
questions, leave it down
conference.
in the comments and I'll get to them later.
Thank you and good morning. Welcome to SOFI's second quarter 2026 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Unless otherwise stated, we'll be referring to adjusted results for the second quarter of 2026 versus the second quarter of 2025. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you and good morning, everyone. I'm pleased to share that we had nothing short of an exceptional quarter. Q2 was our 19th consecutive quarter exceeding the Rule of 40 with a score of 70. This included exceptional revenue growth of 40% year over year and a 30% EBITDA margin. Our team has continued to execute at a remarkable level, and our business mix has proven its durability, driving record growth and profitability in the face of a volatile interest rate environment. Few businesses have maintained such a strong combination of growth and returns for what has been nearly 5 years, and it still feels like we're just getting started. Our success is driven by our focus on building innovative products that are far superior to what is available from traditional banks and fintechs alike. Our members recognize this, and as their needs grow, they take out additional products and become our greatest advocates. This in turn fuels our growth and financial performance. Despite our significant scale, our growth has not slowed. We added a record 1.1 million new members in Q2, increasing total members 35% year over year to a total of 15.8 million members. To put this in context, we had 650,000 total members when I joined in 2018, and we are now adding that amount every 7 or 8 weeks. We also, for the first time, added twice as many products as members, despite having such rapid growth in members. We added a record 2.2 million new products in Q2, increasing total products by 42% year over year to 24.4 million products. This is a huge milestone for our Everything app strategy, as more members take out multiple products, driving our competitive advantage and having a superior lifetime value. In fact, we've reached an important inflection point with products per member accelerating over the last 2 quarters. We are starting to hit escape velocity on our path to be the winner that takes most in digital financial services. Cross-buy continues to accelerate with 51% of new products opened by existing SOFI members. This is up from 43% last quarter and 35% in Q2 of 2025. That's a year-over-year increase of 16 percentage points. This is a reflection of the trust members have in SOFI and the superior products we are building, which work better together and are designed to promote further cross-buy. 2 of the clearest examples of our unique ability to package all that we offer into uniquely differentiated products are SOFI Plus and SOFI Coach. Both are only possible because of our diverse set of products and services, and their usage drives cross-buying that powers our financial services productivity loop. SOFI Plus is our premium membership offering that brings the best of every SOFI product into one experience with a value that is unrivaled in the market. At the start of the second quarter, we relaunched SOFI Plus with significantly enhanced benefits in each of our products. For example, SOFI Money at 4.5% interest, and SOFI Invest with a 1% match, while fully transitioning the product to a paid subscription model. The results have exceeded our expectations. After just 1 quarter, we surpassed 200,000 paid subscribers, with most of the growth coming from existing members who are upgrading their memberships. This equates to an annualized revenue of over $24 million. Importantly, we're seeing incredibly strong cross-buy. 85% of new SOFI Plus members were existing members, and 25% of those are adding another product after Plus, with SOFI Invest accounting for the highest percentage of the follow-on demand. For new to SOFI members who join via SOFI Plus, SOFI Money is the main product that is subsequently being adopted. And across both groups, we're seeing very strong adoption of SOFI Relay and our lending products. SOFI Plus is doing exactly what we designed it to do. It's creating a recurring revenue stream. It's increasing awareness of the breadth of products in our Everything app. It's driving greater cross-buy, as well as increasing deposits, spending, and AUM in the existing open accounts, all in hand increasing member lifetime value. It's the financial services productivity loop in action. We are encouraged to see the success so far, and I'd be disappointed if we are not at 1 million SOFI Plus members generating annual revenue of $120 million a year from now. That same strategic focus on deepening member relationships is behind SOFI Coach, which launched in June. SOFI Coach brings together three things no other company can: the full picture of a member's personal finances across their SOFI products and third-party products, the trust and security of a regulated bank, and soon, the ability to perform actions on behalf of our members. The result is personalized financial guidance across a member's entire financial life that helps them achieve the most critical success factor on their way to realizing their ambitions, which is spending less than they make and investing the rest. A key driver of Coach's success is our unique data set from both our breadth and depth of products, services, and activities. Coach is powered by SOFI Relay's hub of financial data that spans 12,000 connected financial institutions, 6.5 billion transactions, roughly $750 billion in outstanding balances, and over $250 billion in member real-world assets. This unique data set gives SOFI Coach an amazing level of insights on which to base its responses to members' financial questions and soon-to-be proactive insights to what members can do. Since Coach's rollout, we've already seen nearly 500,000 conversations with over 90% positive feedback. Every interaction with Coach gives us real-time insights into what matters most to our members, what they need, and where we can help them the most. For example, more than half of the conversations to date have focused on investing. We believe we can uniquely help the nearly 65% of Americans over the age of 18 that do not buy stocks, ETFs, or invest in robo-accounts become great investors. This is just the beginning for Coach, and we'll continue to expand its capabilities. One of my favorite questions to ask is how much I've spent on subscriptions in the last month. Suffice it to say, I'm astonished by how many subscriptions I pay that I no longer need. I cannot wait for our launch of automated subscription management and cancellation coming later this year. SOFI Plus and Coach are exactly the kinds of products that make our model more powerful over time. They help members get their money right across their entire financial life, they deepen engagement across the platform, and they create more opportunities for cross-buy, resulting in more lifetime value that we can reinvest in better interest rates on checking and savings, better interest rates on tokenized deposits, higher matches on contributions to your invest account, lower interest rates on home loans, personal loans, and student loans, and better services like free certified financial planners. The durable and consistent 35% growth in our members and the inflection point in products per member and cross-buy that we've seen in the last 2 quarters are a direct result of these 2 everything products in our Everything app driving the financial services productivity loop, and we could not be more excited about our strategy and execution coming together as we pull away from the industry. With that, let me now turn to the second quarter results. In Q2, adjusted net revenue was ahead of expectations and up 40% year-over-year to $1.2 billion. Importantly, our revenue growth continues to be durable and diversified. Total fee-based revenue was $472 million, representing 39% of total revenue in the quarter. This is an increase of 22% from last quarter and up roughly 38% year-over-year when normalizing SOFI Technology Solutions, or STS. The growth was driven by origination fees as well as strong performance from our loan platform business, interchange revenue, brokerage fee revenue, and SOFI Tech Solutions revenue. In the second quarter, we generated $1.2 billion in cash revenue. This was our 3rd consecutive quarter of generating over $1 billion in cash revenue. Our lending segment had another very strong quarter, generating a record $712 million in adjusted net revenue. In total, we had our best quarter ever for loan originations at $14.8 billion, which was up over $2.5 billion from just last quarter and included record originations across personal, student, and home loans. This was our first $10 billion quarter of personal loans. Of the $14.8 billion in total originations, $11.7 billion was for our lending segment and $3.1 billion was for our loan platform business. The diversification across channels demonstrates the strength and optionality that comes from having a fortress balance sheet and strong demand from our capital markets partners. Similar to Q1, we are balancing loans originated for our balance sheet with loan platform business originations to drive both returns and great visibility of net interest income for the next 6 to 8 quarters. Loans originated for our balance sheet are providing a competitive advantage in a large, durable, and highly visible revenue stream with attractive returns, which is allowing us to make massive investments relative to our digital competitors. For example, from Q1 2024 until Q2 2026, we have generated $5.4 billion in cash net interest income, which has allowed us to make significant investments to launch new businesses and drive high rates of growth in both members and products. Additionally, the net interest income recorded of $5.4 billion is 2.7 times the cumulative non-cash premium on our balance sheet of $2 billion. So not only is the scale of net interest income revenue an advantage, we are delivering significant returns compared to the original marks recorded in our non-cash revenue. Together, our financial services and technology platform segments generated revenue of $551 million, representing 46% of adjusted net revenue. Over time, we expect these revenue streams to be more than 50% of our revenue and a key driver of our long-term target return on tangible common equity of 20 to 30%, which is now becoming very visible. In addition to delivering durable growth, we've delivered strong returns and profitability. In the second quarter, adjusted EBITDA was $358 million, up 44% year over year. Our adjusted EBITDA margin for the quarter was 30%. Our incremental EBITDA margin was 31% as we continue to balance reinvesting in the business to drive long-term growth and balancing profitability. Adjusted net income in the quarter was $160 million at a margin of 13%. Adjusted earnings per share were 12 cents, which included a negative impact of roughly half a penny due to higher than expected tax rate. Finally, our tangible book value ended the quarter at $9.5 billion, up 80% year over year, and $7.34 per share, which is up 56% year over year. Let me now turn to brand building and additional product innovations across our business. In the second quarter, unaided brand awareness rose to an all-time high of 10.4%, up 190 basis points year over year. It was another exciting quarter. We saw SOFI brand ambassador Wyndham Clark win the U.S. Open at Shinnecock. We brought together some of the biggest names in country music for CMA Fest presented by SOFI, reaching millions of viewers across ABC, Hulu, and YouTube. SoFi Stadium welcomed the world as host to Team USA in several FIFA World Cup knockout round matches, putting the SoFi brand on one of the biggest stages in global sports. And just yesterday, we announced a multi-year partnership with Notre Dame Athletics, becoming the first brand to appear on the Fighting Irish jerseys across all 26 varsity sports. In football, Notre Dame is in a class of one as the only Division I program with their own broadcast television media deal, giving them a national television audience for primetime games that is well above the average for 95% of primetime professional and college sports. Similar to the SoFi Stadium deal, SoFi will be seen by millions of unique television viewers each week. Turning now to our product innovation. 87% of our products, or 21.3 million total products, are now non-lending products. These include SoFi Money, SoFi Relay, SoFi Invest, SoFi Credit Card and Smart Card, SoFi Crypto, SoFi Protect, SoFi Plus, and recently launched SoFi Big Business Banking. These products are more broadly appealing, are used much more frequently, and have vastly lower customer acquisition costs than our lending products. And as such, put the sword in member acquisition that fuels our downstream loan originations via cross-buy at superior customer acquisition costs. The breadth and depth of our product ecosystem and the scale we've achieved with 21.3 million non-lending products that members engage with regularly will increasingly strengthen our competitive advantage and drive long-term growth in a way few financial services companies can match. Here are a few highlights. Our Invest products grew 38% year over year, while brokerage revenue increased nearly 2.5x. That reflects both growing engagement and stronger monetization. We know savings get you by, but investing gets you ahead. Savings alone won't get members to their financial goals. They also need to be investing for the long term. Yet 65% of Americans still don't invest. Our goal remains to make investing simpler and more accessible by giving everyday investors access to the best tools and opportunities which they have not historically had. For example, during the second quarter, we brought AI to SoFi Invest with the launch of Composer by SoFi. Composer lets members turn investing ideas written in plain terms into strategies they can build, test, and automate in minutes. It is simple, intuitive, and accessible, fitting perfectly into the SoFi Invest platform. In June, we also gave members access to the record-setting SpaceX IPO, which became the largest and most subscribed IPO offering in SoFi's history. It was our 36th IPO offering over the past 5 years. This year alone, we've completed more IPO offerings than in all of 2025, and we're excited about the pipeline of companies that may go public this year. Just this month, we launched SoFi Social 50 Income ETF, which gives investors exposure to an options-based income strategy without having to build and manage covered call positions on their own. This fund combines the 50 most widely held stocks across SoFi self-directed brokerage accounts with an actively managed option strategy seeking monthly income and long-term growth. Now let me spend a minute on SoFi Credit Card. We think we've cracked the code on efficiently acquiring high-quality credit card members. Year over year, credit card revenue has more than doubled. In fact, credit card revenue is up nearly 50% and products are up 17% from just last quarter. We're excited by the trends we are seeing, not only in the back book, which reached profitability, but also our ability to add the right members in this important product. Turning now to crypto and big business banking, where we're building the infrastructure to bring blockchain-based financial services to consumers and businesses alike. We have been pioneers in this space, becoming the first nationally licensed bank to launch crypto trading and our own stablecoin in SoFi USD. In the second quarter, we began settling our trading business in SoFi USD, and in big business banking, we began processing transactions on the SoFi Exchange network, enabling our first commercial clients to move money in real time 24/7. This marks an important milestone for two reasons. First, it creates more real-world commercial use cases for SoFi USD, helping to scale our new lower cost, faster and safer proprietary payment rails. And second, it significantly expands our enterprise offering for SoFi Technology Solutions, creating new opportunities for both fee-based revenue and net interest income over time. Big business banking clients can now hold funds in regulated insured business deposit accounts, move money and digital assets in real time through API-driven payments, and seamlessly convert between fiat and digital assets, all within SoFi's regulated banking environment. We first announced big business banking in January, and just months later, it's already in market and serving commercial clients. That speed of execution reflects both our culture and the capabilities of the SoFi Technology Solutions cloud-native banking core on which big business banking was built entirely. Big business banking isn't the only powerful proof point for SoFi Technology Solutions, or STS. We've begun onboarding SoFi Money to our new, modern, cloud-native banking core, fully developed by STS and purpose-built for U.S. regulated banking environments. The platform will soon be available to other banks, financial institutions, and brand partners. This marks the first major U.S. bank to join the platform, serving as a proof point for other large U.S. institutions who want to modernize their infrastructure to meet the demands of the evolving financial landscape. We're also accelerating SoFi Technology Solutions capabilities. During the quarter, we acquired Peach Finance, adding new platform services across credit card, lines of credit, buy now, pay later, and installment lending. The acquisition strengthens our offering for banks, credit unions, fintechs, and enterprise clients, while also positioning us to bring SoFi's own credit card processing in-house and launch a full-stack revolving credit card platform for our clients. Turning now to innovation with our lending products. Since 2024, we've been referring members to small business lenders through our online marketplace. but recently we identified an opportunity to serve these folks directly with a SOFI small business loan. Entrepreneurs and small business owners are the backbone of our economy, yet they are not well served. On one hand, you have banks and credit unions that are not providing the necessary access to capital or doing so at a snail's pace. And on the other hand, you have newer entrants that are charging exorbitant rates. Our new small business loan combines competitive pricing with the speed and simplicity members expect from SOFI, helping us serve more of our members' financial needs seamlessly on one digital platform. We are starting off by originating SMB loans through our loan platform business to establish partners. In the future, we may also create optionality to hold these loans on our balance sheet to generate recurring net interest income. In the second quarter, we also launched our new home equity line of credit experience, giving members fast access to a revolving line of credit right in the SOFI platform. Unlike most lenders, SOFI offers both home equity lines of credit and home equity loans, allowing us to match members with the right solution while providing a lower cost alternative to unsecured loans, and all with the speed and simplicity members expect from SOFI. Together, these products accounted for 1/3 of our record home loan originations during the quarter, helping drive growth as purchase and refinance remain muted in this high rate environment. We had an amazing quarter on any measure. Our exceptional member and product growth continue to demonstrate the trust and confidence that our members have in the quality of our products that keeps them coming back for more. Our offering is unmatched across traditional banks, fintechs, and everyone in between. We continue to make significant investments in our platform, adding new products like SOFI Coach and making existing products like SOFI Plus even better. These investments reinforce what makes SOFI different, a seamless, integrated experience that helps our members do more with their money all in one place while advancing our mission to help people get their money right. Our execution has led us to an important inflection point in our strategy and results. As our member base grows, cross-buy increases, and engagement deepens, the power of our financial services productivity loop continues to compound. That flywheel is driving higher quality, more durable earnings, and positions us to achieve our long-term target of 20 to 30% returns on tangible common equity. We are building a financial services company with a business model that we believe is increasingly differentiated, increasingly profitable, and increasingly difficult to replicate. With that, I'll turn it over to Chris.
Thank you, Anthony. We had a strong second quarter and have great momentum heading into the back half of 2026. Our innovation and brand building continue to power exceptionally strong revenue growth. In the second quarter, adjusted net revenue grew 40% to $1.2 billion. Importantly, we generated $1.2 billion in cash revenue in Q2, our third straight quarter exceeding $1 billion of cash revenue. This included $790 million from net interest income and approximately $420 million from interchange fees, brokerage fees, technology platform fees, loan platform fees, and loan origination fees. Cash is defined and accounted for the same universally, no matter what type of company it applies to. In addition to our strong revenue growth, we delivered strong profitability during the quarter. Adjusted EBITDA was $358 million, up 44% year over year at a margin of 30%. Adjusted net income was $160 million at a margin of 13%. Net income was up 61% year over year. And adjusted earnings per share was 12 cents, which included a negative impact of roughly half a penny due to a higher than expected tax rate. This was our 11th consecutive profitable quarter. Turning now to our segment performance, starting with financial services. For the second quarter, financial services net revenue was $466 million, up 29% year over year. Contribution profit was $213 million, up 13% from last year. And contribution margin was 46%. Net interest income for this segment was $249 million, up 29% year over year, which was primarily driven by growth in member deposits. Non-interest income grew 28% to $217 million for the quarter. During the quarter, we achieved record interchange fee revenue, which was up 67% year over year and 25% from just last quarter. This was driven by more than $28 billion in total annualized spend across money and credit card. We also achieved record brokerage fee revenue, which was up 2.4x year over year and 20% from just last quarter. During the second quarter, our loan platform business generated $143 million of revenue, driven by the $3.1 billion of personal loans originated on behalf of third parties, as well as referrals. This includes $2 million of servicing income recognized in our lending segment. Our loan platform business helped us achieve another quarterly record in total personal loan originations of $10.7 billion, meeting incremental demand from our members beyond what we would put on our balance sheet. Note that during the second quarter, we had significant demand from LPB partners over and above what we decided to fulfill, but we did fill all demand from our contractual commitments and more. We have also recently made several positive advancements with our loan platform business. First, we've reached an agreement with a new partner, Sixth Street, to invest in personal loans totaling up to $1 billion. Second, we've expanded our offering to include our new SMB loan product and have agreed to terms on a 3-year, $3 billion agreement with Base Point Capital. Third, we've just further expanded our offering to include our home equity loans, with the first loans being transferred in the coming days to a leading global bank. Adding 2 new loan types to the loan platform business is a significant achievement that will not only provide opportunities to grow our capital-light fee-based revenue, but it will also allow us to serve more members, generating more cross-buy over the long term. LPB is a great example of how we can build highly scalable, tech-driven platform businesses. Shifting to our tech platform segment. For the second quarter, we delivered net revenue of $85 million, up 13% from the prior quarter. Contribution profit was $12 million at a contribution margin of 14%. Revenue growth was driven by further monetization of existing clients, as well as contributions from new clients. Turning to our lending segment performance, which was very strong during the quarter. For Q2, adjusted net revenue for the segment was $712 million, up 59% from the same period last year. Contribution profit was $399 million, with a 55% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 54% year over year to $573 million. The balance of the growth came primarily from loan origination fees, which were up 64% year over year. During the quarter, we saw continued record member demand for our lending products. For personal loans, we delivered record originations of $10.7 billion, of which $7.6 billion was originated for our balance sheet. The ability to hold loans on our balance sheet is a key differentiator for SOFI, allowing us to generate predictable, recurring net interest income and to efficiently deploy our capital to generate strong risk-adjusted returns. For example, our core personal loan product generated a roughly 6.1% risk-adjusted margin in Q2. This consisted of a weighted average coupon of 12.9%, a funding cost of 3.1%, and annualized losses of 3.7%. Our ability to generate loans with attractive risk and return profiles supports our strong revenue growth through both balance sheet lending and our loan platform business. In addition to the record personal loan originations, we also saw record originations in student and home loans. Student loan originations were $2.7 billion, up 2.7x from the same period last year. Home loan originations were $1.4 billion, up 74% from the prior year. Turning to capital markets, where activity continued to be strong in the second quarter. During the quarter, we transferred $3.1 billion of personal loans through our loan platform business. We also closed $834 million in home loan sales at a blended execution of 101.6%. Consistent with prior quarters, we sold $90 million of late-stage delinquent personal loans. In addition to these loan sales, we executed 2 securitizations of loans originated on behalf of our partners through the loan platform business, totaling $1.37 billion. These transactions priced at an industry-leading cost of funds levels with weighted average spreads of 91 basis points and 86 basis points, respectively. In fact, 86 basis points was our best ever pricing, reflecting exceptional demand for SOFI-originated loans. I would also note that our most recent deal was meaningfully upsized from the original deal size. Turning to credit performance, Our credit performance remains very strong overall, performing in line with our expectations and driving attractive returns across all loan types. For personal loans, we saw a very strong credit performance during the quarter. Excluding the impact of delinquent loan sales, the estimated all-in annualized net charge-off rate was 3.7%. This 70 basis point decrease from last quarter was driven by an improvement in the underlying credit performance as well as growth in average loans on the balance sheet. Including the impacts from the DQ sales, the net charge-off rate was 2.62%. This is down 41 basis points from the first quarter and 21 basis points from the second quarter of 2025. The on-balance sheet 90-day delinquency rate was 40 basis points, down 7 basis points from last quarter. For student loans, the annualized charge-off rate was 61 basis points, down 4 basis points from the prior quarter. The on-balance sheet 90-day delinquency rate was just 11 basis points, up 1 basis point from the prior quarter. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which is done alongside an independent valuation specialist. This is based on actual loan level data and considers a number of factors, including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate comprised of benchmark rates and spreads. At the end of the second quarter, our personal loans were marked at 104.7%, down 71 basis points from the prior quarter. This was driven by an increase in the discount rate, which was up due to higher benchmark rates, as well as a modest increase in the default rate and prepayment rate assumptions, and a small decrease in WAC. At the end of the second quarter, our student loans were marked at 104.4%, down 85 basis points from the prior quarter. This was driven by an increase in the discount rate due to a higher benchmark rate, partially offset by a modest decrease in the prepayment rate. The WAC and default rate assumptions remained relatively consistent with the first quarter. Turning to our balance sheet. In the second quarter, total assets grew by $7.2 billion. This was driven primarily by $5.8 billion of loan growth and roughly $800 million of growth in cash equivalents, and investment securities. Total company-wide cash at quarter end was $3.6 billion. On the liability side, total deposits grew by $5.3 billion to $45.5 billion, which included strong growth in member deposits. Our net interest margin was 5.98% for the quarter, up 4 basis points sequentially. This included a 7 basis point increase in average asset yields, partially offset by a 1 basis point increase in cost of funds. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we are very well capitalized. Our total capital ratio of 18.8% at quarter end is well above the regulatory minimum of 10.5%, as well as our additional internal stress buffer. Over the medium term, we expect to efficiently deploy our excess capital into high-returning assets while letting our risk-based capital ratio normalize toward the low to mid-teens. Tangible book value grew $4.2 billion year-over-year to $9.5 billion. The tangible book value per share at quarter end is $7.34, up from $4.72 a year ago, a 56% increase. Let me finish by providing our outlook for the year and some longer-term thoughts. In line with market expectations, we now expect an interest rate outlook consistent with the Fed funds futures in 1 to 2 hikes in 2026 versus the expectation of 2 rate cuts when we first provided our 2026 guidance. Now for our specific guidance. For the full year 2026, we now expect to deliver adjusted net revenue of $4.75 to $4.85 billion, which equates to year-over-year growth of approximately 32 to 35%. This is up from our prior guidance of approximately 30% year-over-year growth. We continue to expect to deliver adjusted EBITDA of approximately $1.6 billion, which equates to an adjusted EBITDA margin of approximately 33 to 34%. Adjusted net income of approximately $825 million, which equates to a net income margin of approximately 17%. And EPS of approximately 60 cents. Our EPS guidance now includes a tax rate of 22%, which is approximately 700 basis points higher than our original guidance. At the same mid-teens tax rate as our original guidance, our new guidance today would have actually been 65 cents in EPS instead of our actual guidance of 60 cents in EPS. As we look out over the longer term, we are on a path to generating returns on tangible common equity in the 20 to 30% range. ROTCE is the product of net income margin times the amount of revenue generated per dollar of tangible equity. For example, a 25 to 30% net income margin combined with approximately $1 of annual revenue for every dollar of tangible common equity produces roughly a 25 to 30% ROTCE. Achieving both the net income margin of 25 to 30% and the revenue of equity ratio of 1 is embedded in our strategy with a very visible path from where we operate today. First, we expect continued expansion in the net income margins due to both higher margin businesses becoming a larger part of our mix, and we continue to realize operating leverage. Second, we're increasingly generating more revenue without a commensurate increase in equity by growing more capital-light, fee-based businesses. We have high visibility and confidence in our target net income margin because our incremental net income margin has already been approximately 30% while growing revenue more than 35%, demonstrating that these margin levels are achievable. As the business matures and incremental margins increasingly become overall margins, we believe the path to a 25 to 30% net income margin is highly probable. Revenue to equity is a function of revenue mix and capital efficiency. We believe both of those outcomes are achievable over time through execution of the strategy we're already pursuing, which is why we have confidence in our long-term return profile. Overall, Q2 was a strong quarter, and we continue to have strong momentum in our business. Let's now begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. Please keep in mind we'll take only one question per person at a time. Please rejoin the queue for any additional questions. Thank you. Your first question comes from Devin Ryan with Citizens Bank. Your line is open.
Thanks. Good morning, Anthony and Chris. And first off, congratulations on the Notre Dame partnership, my alma mater. So good to see that yesterday. You got a lot of attention. Question just on loan platform and really want to focus on some of the new capabilities with SMB and home equity and the new agreements that you guys have recently announced. Can you just give a little bit of context around the capacity that you see in kind of some of these newer categories, and also how quickly SOFI can build origination volume into that capacity, and just also how we should think about kind of the fee economics in these new categories as you kind of expand beyond personal loans? Thanks.
Yep, absolutely. Thanks, Devin. So in terms of the loan platform business, that was originally started a few years ago, primarily as a referral channel where we were sending all of our declines to a marketplace and generating a fee. That evolved over time to where we started to originate on behalf of others in meaningful scale from an unsecured personal loan perspective. I would say, and I've said this consistently, the nirvana state for the LPB business is to be able to go to investors with a menu of options and asset types that allows them to pick and choose exactly what they would like from both the risk and reward and return profile perspective. And one of the key things that we needed to achieve was to start expanding the loan platform business into other asset types. And this is the first quarter where we were able to do so by introducing the SMB partnerships. There are two of them. One is with Base Point Capital for $3 billion over 3 years, and the other is with an undisclosed party for several $100 million. And then we are also introducing home equity lines of credit to the mix as well in the coming days. In terms of the overall size and scale and opportunity and our ability to originate into that, we're just starting to originate in meaningful scale on the SMB side. There's considerable demand from an application start perspective, and you would expect to see economics in the range of where we're executing today to maybe slightly better On the closed-end seconds and mortgage side, similar story. We're already originating at a pretty good clip right now on a monthly basis. And the partnerships that we're talking about are in the $100 to $200 million per month, but we're talking to several parties. But we certainly have the ability to originate into that. And again, from an economics perspective, we don't disclose that by party, but you could expect it to be, similar to where we're executing today.
And the other thing I would add is that as we continue to build out a more diversified portfolio of loan platform businesses, we build new relationships that can benefit existing loan platform businesses. The SMB business is one that we think we can be incredibly competitive on. Similar to personal loans and credit cards, most SMB lenders are charging exorbitant rates of over 30%. We think we can operate meaningfully below that and take significant market share. If you think about our portfolio of loans and originations more broadly, we are really taking massive market share from high return, high profit margin types of products. So in personal loans, we're underwriting WAC at about 12% compared to credit card at 25%. That's an incredibly compelling value proposition for any individual consumer. In SMB, as I mentioned, we could be 10 or points below where the pricing is on SMB. Closed end, also, we can be more competitive than others. And because we're more competitive on price, we get higher quality borrowers, which will only reinforce the productivity loop of originating high quality borrowers, delivering great return assets to our partners, putting great return assets on our balance sheet, driving capital that can continue to fund that. And we're very close to that whole equation playing out.
Your next question comes from Andrew Jeffrey with William Blair. Your line is open.
Thank you. Good morning. Great to see the momentum you have in the business. Anthony, kind of a high-level question for you. I know the company has been sort of hyper-focused on driving members given the size of the TAM. And now it seems that cross-buys reached a pretty important inflection point. Is this the time to sort of focus on monetization sort of at the margin versus member growth? Or do you think you walk and chew gum and we see both metrics rise over the next couple of years?
It's an important point that you bring up. It was an important inflection point for us in this quarter. It started in Q1. We didn't want to overemphasize in Q1 relative to Q2, but make no mistake about it. This is the first half of this year has proven that our broad-based everything app strategy is working. We've seen improvement in products per member in Q1 and Q2. We continue to expect that to happen for the foreseeable future. We have the right portfolio of products where people are organically acquiring the next product. And so if you think about Relay and you think about SoFi Money, those are tip of the sword products that are broadly appealing. We have over 7 million Money members now, over 6 million Relay members. The more Money members we bring in, the more Relay members we bring in, the more downstream benefit we get in SoFi Invest and SoFi Credit Card and SoFi SMB, as well as all the loan products. And those acquisition costs are basically zero on those other products, which basically doubles the profitability on the loan side. And so there's a great flywheel here at work. And what's changed this year is that the SoFi Plus product, the SoFi Crypto product, are absolutely driving product per member organically. So as we mentioned in the remarks, SoFi Plus relaunched. We're already at over 200,000 paying members, which is on a run rate basis going to be over $24 million a year, and it's growing very rapidly. But the most important thing is that 85% of those new SoFi Plus members are existing members. And a quarter of them are taking out another product after they take out SoFi Plus. So if an existing member takes out SoFi Plus, they have at least 2 products since they're existing, and then 25% of them are taking out another product. Layer on top of that, more broadly appealing products like crypto and more broadly appealing products like SMB and now big business banking, and you can see the flywheel really working. So our growth is going to be driven by members, by products per member, and by revenue per product. So all three working for us, and you saw that in the quarter.
Your next question comes from John Hecht with Jefferies. Your line is open.
Hey guys, good quarter. Thanks very much for taking the question. Anthony, I'm wondering if maybe you can give us an update on the competitive, the competitive environment and like customer acquisition costs and channels, and how are those trends going?
Yeah, outside the loan business, the competition is very benign. Our customer acquisition costs are staying pretty stable. The team's doing a great job of really optimizing unit economics and driving efficient scale and customers. The fact that we're driving 35% year-over-year growth in members and over 40% growth in products and really keeping CAC constant is a function of the great data analytics we have and the value prop that we have. Each one of our products, we absolutely designed to be the best of breed on its own, both from a value prop to the consumer as well as a unit economics. So we're indifferent in what product they take first, but we're seeing continued strong demand in our channels at stable pricing in all of the financial services products. The lending products are definitely more competitive, but we have very unique products. So in personal loans, we're really not competing with big banks. They don't offer personal loans primarily because they have these huge credit card businesses that they don't want to cannibalize. So we're kind of competing with the smaller companies that don't have as much capital and they have higher cost of funding than us. So we've competed really well. But don't get me wrong, like I'm focused on funnels and pricing every day in the PL business. The student loan business doesn't really have a competitor in the home loan business. So overall, pretty benign environment at the top of the funnel, bottom of the funnel, nothing's changed, but it's always been competitive on pricing. And we're pretty nimble and have a significant advantage in lower funding costs than others. Not to mention a large percentage of home loans are cross-bought from existing members and increasingly a higher percentage of personal loans is cross-bought again without customer acquisition costs.
Your next question comes from Dan Dolev with Mizuho. Your line is open.
Hey guys, really nice results. Congrats. Just wanted to ask, maybe Chris, can you walk us through the rationale of not raising the EBITDA? Obviously, results are super strong. Just some color on that. I think a lot of investors are asking. Thank you so much and congrats again.
Yep, absolutely. Thanks, Dan. So we ended up raising guidance from a revenue perspective, about $100 to $200 million. That obviously reflects the continued strong execution and strong demand that we're seeing across the entire business. And as we've said before, when we see opportunities to deploy capital at attractive returns, we're going to lean into them. And that's what we're doing today. There are just too many large attractive growth areas for us to invest versus adding even more profitability. The profitability opportunity is not going to go away, but choosing not to invest today would come at the expense of capturing that growth opportunity in the future. The incremental revenue gives us obviously the additional flexibility to invest in initiatives that we believe will drive long-term growth while maintaining the EBITDA and EPS guidance that we've provided.
Dan, the other thing I'd say is we don't want to over-optimize for the actual EPS that we hit or the actual EBITDA that we hit relative to these bigger growth opportunities. But we also do need to be balanced relative to the environment. And while we couldn't be more positive about the demand for our products, the performance that we're driving with them, the credit trends we're seeing, the spending trends we're seeing, as well as the investing trends, all of those things are green and up and to the right. And so that's what's allowing us to drive such strong demand. It's not coming at higher costs, which I think is what a lot of people will point to. The incremental investment is on new growth opportunities. This year, we've launched a number of things that were never in our 2026 plan. We just launched big business banking. We launched SMB. We launched SOFI USD. We launched SOFI crypto. And we're leaning into SOFI Plus because of how well it's doing. So that momentum is absolutely continuing. The other thing I would just say is we entered the year expecting rate cuts. We're now expecting 2 rate increases. We've not only maintained our guidance for revenue and profitability, we've exceeded expectations on the revenue side. So when we think about the back half of the year, I don't know if there's going to be 2 rate cuts. If they are, we're going to be fine. 2 rate increases. If there are, we're going to be fine. If there are no rate increases, we probably have upside to the bottom line. But we have the cushion in our guidance to be prepared to deliver regardless of the environment.
Your next question comes from Kyle Peterson with Needham. Your line is open.
Great. Good morning. Thank you guys for taking the question. Wanted to talk on the loan platform business. I think this is the second quarter in a row you guys have talked about the demand is really good from the buyers, but you guys aren't necessarily fulfilling some of the upsized requests based on like capital levels and unit economics for you guys. So I guess how should we think about, should that continue on the personal loan side moving forward as you guys still have really strong capital ratios? And I guess like is any of that volume decision impacted by, HELOCs and, SMB starting to get ramped up on the platform? Thank you.
Yep. Yeah, absolutely. Thanks, Kyle. So I'd say on how we're feeling about the PL business as it relates to LPB, we're happy with that level of volume. We're able to meet all of our contractual commitments and then some. And where you're going to start to see more meaningful growth is in some of these other asset types, and I walked through those earlier in the call during my prepared remarks and in the first question. As it relates to some of the capital consumption questions and how that pertains to LPB, what I would say is that we're self-funded through our guidance period and the medium-term operating plan that we've laid out. As our profitability continues to improve, our organic capital generation is going to continue to increase as well. Combined with continued growth in our capital-light businesses that Anthony's mentioned, as well as the flexibility that we have in how we monetize our originations, whether that's through the LPB program or on the balance sheet, we believe that we can operate comfortably within our target capital range without the need to raise capital under our current operating plan.
Your next question comes from Pete Christensen with Citi. Your line is open.
Thank you. Good morning. Really nice results here. Anthony, I'm curious, with introducing some of these more commercial-like products, how should we think about the cross-buy flywheel here, or I guess in the future, and putting it around some of these newer offerings? Is it, hey, there's a small business, we could connect to some of the proprietors there, maybe for personal banking, or do you envision some additional services that could serve, that market to increase cross-buy?
Yeah, what I'd say is the following. The most common sort of path or stage someone goes through is they come in through SoFi Relay or SoFi Money. They come through Relay, the most prominent next product is going to be SoFi Money. If they come in through SoFi Money, there's going to be a path to Relay or to SoFi Invest or to loans. SMB really was born out of the fact that a large percentage of our members actually are small business operators. And back during COVID, when the government provided PPP loans, we got a significant amount of demand for applications on PPP loans, even though we were not in the SMB business. We actually stood up an application process that met the government's application criteria and helped pass on that demand to lenders. And then on the back of that, we built a marketplace so that we actually get paid for that referral process that we're doing. So the SMB business is very much synergistic to the rest of our business. And I would think of it as just another use case for an individual to satisfy the needs they have from a borrowing standpoint. We'll obviously follow this up with checking and savings in SMB and other products that are ancillary to that. And so it will add to the flywheel. Big business banking, I don't think is truly appreciated by people outside the company. We were looking to partner with marketplaces and market makers in crypto, and everyone we talked to said, can you please be our actual bank? Can you build a fiat and crypto banking capability that's API driven? And that's where that business was born out of. And so not only will it be a business on its own, it'll drive second order benefits in driving more usage of SoFi USD. And the SoFi USD product is going to be driven obviously by the net interest income from leaving that cash at the Fed bank and earning Fed funds on it. And so we have a number of pieces of demand for SoFi USD. You have big business banking, which is now up and running, and people can use SoFi USD as a form of payment in those payment rails. We have our crypto business, which is actually settling in SoFi USD. On the consumer side, we have our debit and credit card with MasterCard. We'll begin settling in SoFi USD with MasterCard in the coming weeks. And so these businesses are starting to layer on top of each other, and there's synergies across them.
Your next question comes from Will Nance with Goldman Sachs. Your line is open.
Hey guys, thanks for taking the question. I wanted to ask a question on the SoFi Plus commentary that you had and some of the membership growth that you guys have seen. I was hoping you could maybe talk through just the profile of the customers that are adopting the product. What have you seen from a wallet share perspective or an engagement perspective? Have you seen things like average deposit balances increasing or engagement with the SoFi platform increasing on the back of some of those signups? Thanks.
Yeah, our hope when we relaunched SoFi Plus is that it would increase the awareness of the other products that we offered that existing members may not be aware of or new members may not be aware of, because SoFi Plus is meant to be the best of every individual product. So if you sign up for SoFi Plus compared to just SoFi Money, you get a higher interest rate, you get other bells and whistles. If you sign up for SoFi Plus compared to just SoFi Invest, you get a 1% match. And each product, credit card, better rewards, et cetera. So of the 206,000 SoFi Plus members that we reported in the quarter, 85% of them are existing members. And it's the same demographic of our member base already because they are members. And the 25% incremental purchases of a new product after SoFi Plus, it's primarily the thing that's benefiting the most is Invest. And that's really encouraging. That means we're increasing share of wallet. We have investors for the first time that are novice to new investors, but we're also getting investors that are transferring their money because of the match. Secondarily, the SoFi Money product is the product that benefits if SoFi Plus is in that 15% bucket. So SoFi Plus is the first product of a member. The second product that they're buying is SoFi Money. In terms of the actual second order effects of their existing activity, a SoFi Money member that takes out SoFi Plus, 1/4 of them are taking out a third product, but we're actually seeing increases in their deposits on the back of that SoFi Plus subscription sign up, and we're seeing increases in AUM as well, and we're seeing increases in spending. So there is a benefit for more products being taken out from SoFi Plus, and there's a benefit for more engagement as defined by more deposits, more AUM, and more spending. Here's a really interesting data point. I looked back at the Q1 2021 cohort. Of the Money members in the Q1 2021 cohort that became Money members that quarter, with the launch of SoFi Plus, we increased the product per member of that cohort by one product in the quarter, which is, if you think about it, that's almost 5 years old, that customer that was acquired, and they added one product for the entire cohort in the quarter. So it's having a really strong impact, and that's why we mentioned in the earnings results and in my comments that we're seeing an inflection point benefiting from the flywheel. Crypto is also contributing to that flywheel as well as a new product.
Your last question will come from Matt Code with Truist. Your line is open.
Hey, good morning, guys. Thanks for taking the question. Anthony, I just wanted to ask about the spend down of that excess capital that you guys have talked about. So you're in that advantageous position where you have a really strong CET1 ratio, a lot of capital to spend, but you brought down that CET1 ratio pretty quickly over the past couple quarters. So could you talk about just capital balance sheet growth and kind of the spend down and the pace of the spend down of that excess capital?
Sure. I'll let Chris get into the numbers in more detail. One of the benefits of growing our balance sheet in Q1 and Q2 of this year is that we have very strong visibility into our revenue for 2027. And that visibility is going to continue because if we maintain our balance sheet at this size, it's going to produce the net interest income that's being delivered today consistently over time. Barring a huge change in the economy or overall credit performance, we can kind of count on that revenue in the future. And that's a really stable thing to have, so we can, at a minimum, fund a significant amount of investments regardless of the environment that we're in. And so when people ask, like, why are you putting loans in the balance sheet? Why are you not doing everything through loan platform business? It's because we want to make sure we have revenue in the future that's visible, that can deliver no matter what, and it's 100% in our control. We layer a loan platform business on top of that, not just in PL, but now SMB and closed-end seconds. And it's a very incremental additive return on top of something that's very visible. And we have 5 years of history. I don't know if people heard the numbers that I mentioned about over $5 billion of cash net interest income from what we generated in Q1 of 2024 through Q2 of 26. But that's an astronomical number, especially where it's 2x greater than what the non-cash revenue was recorded as a premium over time.
I think you can see from this question itself that the analysts are just paying attention to the lending business.
Yep.
And
So we
seems
exited the quarter at an 18.8% total risk-based capital ratio, which is our binding constraint. That's well above the regulatory limit of 10.5%. As I mentioned in my prepared remarks, we believe that having a risk-based capital ratio in the low to mid-teens is appropriate for this business longer term. And like I said a few minutes ago, based on our current operating plan and the guidance that we've provided, we feel really good about being able to operate within those confines without the need to raise capital. As you know, as we continue to expand profitability, our organic capital generation will continue to increase. And by continuing to scale our capital light fee-based revenue streams, that will help as well.
At this time,
Operator, I'd like to end with some closing comments. In closing, Q2 marks a clear inflection point in our strategy, where our Everything app is driving higher products per member, resulting in higher lifetime value, supporting superior levels of investment, and our ability to offer more value to our members than anyone else in better rates, products, and services. This continuous reinforcing cycle of the financial services productivity fuels durable growth and high returns. The benefits of this strategy, in our view, are no longer theoretical or a leap of faith. They are 100% in our control via disciplined execution. I'm often asked why I buy the stock, and the answer is simple. I believe we will achieve the returns that Chris walked through before of 20 to 30% return on tangible common equity, and it's just a matter of when, not if, the market can connect the dots to the attractive return potential of our business. Until then, we're going to keep our heads down and continue to execute and deliver for our members and our shareholders. Thank you, and we look forward to talking to you next quarter.
goodbye. This concludes today's conference call. You may now disconnect.
All right. So during that conference call, we saw SOFI fall all the way from $16 down to $15.80. And we are basically fluctuating within this 30-cent range of $16.10 and $15.80. I expect us to basically fluctuate in that range for the rest of the trading day. I don't think the results warrant a 6% drop, but that's because generally our focus when we invest in SOFI is much different from the market. If you actually listen to the earnings call, it was, yes, and also FOMC, plus the fact that I think there were some reports coming out around Trump saying that he's going to attack Iran to retaliate against their attacks on US bases in Jordan, something like that. In terms of my price targets, I mean, I just buy at the lines. So let me just, I can't remember where the lines are. Where is my, okay, it's here. Yeah. And I think that what I missed that portion because I was I missed the portion where he was talking about the tech platform, but I caught the part where he said that there was some US national bank or something like that, a small one at least, that at the end they got it over the line. There's some proof of concept over there. I didn't catch it because I was on my phone, but I will take a look at that. So I think this is really the markets being impatient. The markets saw profitability last year and they wanted to continue to see profitability. And right now, SOFI is not giving them that. Anthony Noto, if you listen to the very last question that was being asked, it was a question around the CET1 ratio. And the analyst basically models SOFI based on expectations around the CET1 ratio, how that will compress, how that's going to affect lending. But you know that if you are invested in SOFI, lending is not the long-term story for SOFI, it is financial services. And Anthony Noto, I think he addressed it very, very clearly. The reason why they are focused on lending right now because it gives them visibility into future cash flows, right? I think when it comes to financial services, loan platform business, tech platform, there are a lot of external variables. In a recession, perhaps people may choose to pull back on spending in the tech platform, and therefore they will not be able to generate as much tech platform revenue, things like that. Those other segments of the business, higher margins, but less visibility. But as they are building out SOFI USD. As they're building out big business banking, they need to have reliable visibility over their cash flows, and that is why they are focusing on their lending. Now, the very interesting thing about lending, which I really do not understand why people are worried about it, is that when you take a look at the CET1 ratio, it's really not that bad. But if you look over here, at least to me, if we break below this, if we do not reclaim the $16.10 range, I think we get down to $15 again. This has been a very strong support, not just in recent times. This goes all the way back over here. You can see if I extend this out, the $15 range, it's been here, up a little bit. So we have had this as support for a while, and then this was resistance once, twice, and then on the third time we broke through. And I think this is the same range that we are looking at for SOFI right now. If we cannot hold above the 0.618, likely if we are opening at 1570, we're opening below 0.618 over here. So I would not rush and buy. If you are looking for an entry, I am waiting for either a reclaim of the 0.618. I would rather buy at $16.10, or I would wait for $15. I wouldn't buy in like no man's land over here. Like I said yesterday, I already opened 10 leaps, and I was very prepared for the 10 leaps to immediately go underwater today. If we had a response like we had today, I was just buying it as a little bit of an upside hedge in case we get fantastic results and they go all the way up to $19. But since they didn't, if I can get another 10 to 20 leaps for 2028, $18 leaps, by the way, then I'll be more than happy, right? So I'm looking at $18 leaps December 2028, and I'll probably buy it as the volatility starts to come down. So I don't really buy leaps based on price only, because you need to take a look at the volatility. So again, this is something that we will see once the market actually opens. So going back to that CET1 ratio discussion, I think one of the things that you have to understand about SOFI is that they are ultimately a rate play for a lot of the people in the markets out there. You can see the CET1 ratio. It really doesn't make sense. I think to me, the annoyance that you're hearing in my voice comes from the way that that guy phrased his question. He's concerned about how fast the CET1 ratio is coming down. That was literally what he said. He wants commentary around the pace of how fast they're drawing down the CET1 ratio. But when you take a look at JP Morgan's CET1 ratio, JP Morgan is at 14%. So SoFi still has around a 5.7, 5.8%, 4.7, 4.8%, nearly a 5% spread between what their CET1 ratio now compared to JP Morgan, the biggest and best bank in the world. So in terms of their capitalization, they are definitely very safe. But at the end of it, you are also hearing Chris Lapointe say that, hey, we can actually see this in the low to mid-teens range, and that is a healthy place to be, which actually tells us perhaps in Q3, they may continue to draw down another 3% of their risk-based capital. So if they put up another strong lending quarter in Q3, wouldn't be surprised about that. So, let me put this in, because I was taking down some notes. And then I got distracted halfway through by looking at the war between US and Iran, which is why I also missed the talking point around the tech platform. CET1 ratio, low to mid-teens expectations. Okay, so that is my commentary around the CET1 ratio. I think it shows you where the analyst heads are at. They are looking at this as a rate play. They are looking at this more purely as a lending business. They don't understand the other parts of the business. That is completely fine. Analysts will do analyst things, and I think I would pay attention more to the analysts that really have a track record in the fintech space. So I feel like I will just take it with a pinch of salt. Like, this is not how I look at SoFi. This is not how most of us looks at SoFi. Their numbers are extremely, extremely strong. I don't think we are seeing any reason why they should be down 6% on the day. Anthony Noto did say, right now, based on our own projections, we are actually expecting revenues to increase and then profitability to come in a little bit light. So this is what we are seeing over here. For the rest of 2026, we are expecting adjusted net revenue to come in at for 4.7 to 4.8 billion dollars, which is a 32 to 35% year-over-year growth. Prior guidance was 4.6 billion dollars. So at least they are showing top line growth. And I think what is bullish is that because Q2 is supposed to be their weakest quarter of the year due to some of their tax obligations and things like that. So I'm expecting that in Q3 onwards, we are going to start to see growth ramp up, perhaps even past 40%. For the last 2 quarters, we were at around 40.5% to 41%. Could we see mid 40% growth in Q3, Q4? Possible. I think it's highly, highly possible. And I think I like Anthony Noto's commentary. He said that if we are expecting 2 rate hikes, then we will likely deliver the numbers that you're seeing on screen, maybe a slight beat on some of these numbers. But if we get 0 or 1 rate hike instead, then of course there's upside to this story. And I think this is exactly what the markets are pricing in. I think the sell-off is accelerating a little bit. SOFI is now down 6% on the day, which means my portfolio should be very, very red, unfortunately, because I'm mostly in SOFI, but I do not expect this to be a very long-term thing. This drawdown is expected, and I think right now, the only thing that I can hold on to is my $4,000 that I receive in covered calls. Thankfully, I didn't close the covered calls early, so at least I feel okay about it. I sold 130 covered calls for 31 cents. So that kind of cushioned a little bit of the fall off. And yeah, so that means, I get to keep all of that covered call money, no problems. And we also have BMNR down around 0.7% on the day. I'll cover a little bit about the other companies and take a look at the portfolio as the market opens. But I think in general, SOFI's business was, I think they perform well, right? They told us that they are reaching escape velocity for digital assets. I don't know how they are quantifying that. I really need to look at the transcript and then can give you a better idea. Cross buy at 51%. I think this is extremely strong. Anthony Noto was saying 85% of SOFI Plus members are existing members, of which 25% of them added new products, which means if you take 85% of SOFI Plus members, new members, that's like over 160,000. 180, 170,000, 25%. So around 40,000 new members added extra products. And that actually brings up their products per member. If they can scale this all the way up to 1 million SOFI members a year from now, that would be absolutely fantastic. Now, Kunal actually asked me in the comments below about Robinhood Gold and how that compares to SOFI. And I would say that it's not really a apples to apples comparison based on the current setup right now. Because if you understand Robinhood Gold, the reason why adoption actually came in so strong was largely because of the Robinhood Gold card. So that was released in 2024. So that, in a sense, kind of already has a 2 years of a runway above what SOFI has, right? So you have the Robinhood Gold card in March. Is it March? When was it released in 2024? March of 2024. So March 2024, you basically have a 2.5 years head start on SOFI. But Robinhood Gold, I believe the $5 monthly subscription that people are talking about, that actually started all the way back in 2016, from what I understand. So that's why you can see Robinhood Gold kind of has around let me see, is it? Let me see, where do I? Okay, the only reason why I know Robinhood Gold started in September 2016 is literally because of Gemini. But I will go and fact check this. But yes, they did say that Robinhood Gold, the monthly subscription, started in 2016. Now, if that is true, that's an interesting barometer for SOFI, I think, because when you consider what SOFI is doing, they have 15 million. Okay, so the way I think about this, if you are looking at it in terms of adoption, Robinhood has around 27, 28 million active accounts, and you have around 4 million people on those active accounts. So if I take 4 million divided by 28 million accounts, you're getting a penetration of around 14 to 15%. So similarly, if you take a 15% penetration of SOFI's members, around 15.2 million, you are looking at around 2 million SOFI Plus members accounts to be on the same level as what Robinhood is doing. And for Anthony Noto, he's saying he's expecting at least 1 million members by the same time next year. So if that is the case, we are halfway there, right? Within 1 year. And Robinhood already has 2.5 years head start if you are talking about the increased adoption due to the Robinhood Gold Card and things like that. So I am perfectly fine with where SOFI is right now. I think this gives me a buying opportunity. I will be definitely looking to, and I think it works out just nice for me because the covered calls expire 7th of August. So that is next week. 7th of August also means that I can give the markets a little bit of time to digest the news around SOFI's earnings. I think this is a little bit of a overreaction, as it always is with SOFI. The last time around, we actually saw the markets come down for a while, and then it rebound at the early part of June, back to around 1850, and I actually think that we can actually see something similar this time around. Markets take a while to digest this, and then a quick rebound closer to uh, market open, not market open, because I'm looking at market open. We'll get a rebound closer to the middle of the quarter. So let's take a look at what's happening. One of the reasons why we are seeing, okay, so that is around SOFI. I will probably do a dedicated video on SOFI. I'll see when, because I need to put out my Zeta and Grab video before their earnings next week. And then I still owe you guys a BMNR video. And the fun fact is that I got the BMNR video all researched and everything, but I haven't put it together. So a little bit of a mad rush, but that's fine. The reason why the markets are dropping, I think, is because of this. US and Iran war flares up again while Saudi Arabia strikes Iraq. And I think they're not striking Iraq itself, they're striking Iranian-backed militia that is within Iraq. Of course, Iraq's government is not too happy about it. So we are not too sure who started what first, right? The IC said that, oh, we are attacking the US base in Jordan because of US aggression. US say that we are attacking Iran because they are attacking us. So you never really know who's telling the truth in this. Yeah. So US and Saudi Arabia jointly hit weapons and other sites belonging to Iran-aligned terrorists in Iraq. Yes, that's it. So I think this is why I think that is why markets are down. Let's see what happens, because it wasn't just SoFi. Like SoFi, the initial reaction to the earnings was just 2 to 3% down, and then we suddenly accelerated the loss all the way down to 6%. Largely, I think, due to the release of Trump tweeting that he's going to attack Iran. Let me see. Do we have oil prices? I believe I have oil prices somewhere. But let me. Okay. All right. So I'm just hearing from Bloomberg that okay, we have crude at around $85. It's up 6% on the day. And Oman actually did give, let me see if I can find the actual article, because I don't think I can share the stream. Oman proposal. Okay, So you have Iran and Oman swap proposals to manage the Strait of Hormuz, but Iran rejected the proposal for the country's joint oversight. I think basically Iran wants full control over the strait. Yeah. Iran's counter proposal would give Tehran more control over the waterway. Now, I mean, I don't know. I feel that Iran kind of realized, oh, we can kind of be a big deal because we can control the Strait of Hormuz. And that's why they are trying to flex their muscle a little bit. But I think there's only a timeline for them to flex their muscle. Like, I think people are getting a. I mean, if they are anti-US, I'm fine. But to reject Oman, who proposed 50-50, to me that shows that they are being a little bit like, I don't know. Yeah, they're trying to take advantage of the situation, basically. And I actually think that the more they do this, they're actually giving people time to build alternative pathways for the oil to move out of the Middle Eastern region. And I don't think they have the ability to stretch themselves all the way up to the northernmost point of the Red Sea. If you can get oil exiting at that point, then I think they lose a lot of leverage. Because if you take a look at where the oil goes to, they are basically blocking the closest way to Asia. But I believe China is one of the biggest importers of oil from Iran. Am I mistaken? So they're basically blocking their own friends. I think that will really lower their leverage. Markets are opening in about 7 minutes. Let's take a look at what is happening right now. If there's anything on this, I will be updating you. I expect Anthony Noto to be on sometime soon. He's usually on for an interview. All right, so you can see huge drop in the public portfolio. We reached around what $128, $128,000. This has fallen considerably to 112. Because I am not able to add money to this account, I have to think of how to raise funds because number one, thinking of buying a little bit of CoreWeave. Number two, wanting to add a little bit more to SOFI over here. Now, right now we have CoreWeave at around 66. Our cost basis over here is 83, so we are down around 19%. I would love to add a little bit more. I do have $10,000 in cash, but it's actually currently being collateralized at $75. So I'm just waiting to see what happens. Yeah, I have Ethereum over here, 1434. This is fine. Down only 3%. Robinhood. I expect Robinhood to have pretty strong earnings, even compared to SoFi. They are less rate sensitive. Plus, I think prediction markets should see them do very well. I think with the current expectations of 2 rate hikes, yes, I think $18 should be pretty fair value for SoFi. Like I said, if you're expecting 2 rate hikes. So I think SoFi right now is a rate play. I don't think we can expect $30 by the end of the year, unless we get lesser than expected rate cuts, which seems unlikely to be the case if the war in the Middle East continues. Zeta is doing well, nearly $22. So let's see how their earnings actually do next week. So far, you can see this is down 10%, and the calls themselves in this account is down just 0.7%. But markets are not open yet. I expect this to fall drastically later on. Perfectly fine. ASTS, we got in at 58. It's now around 57. No problems over here. Service now at around $110. So I basically divested away from Grab recently so that I can convert my Grab position into leaps. I will be waiting for their earnings to decide what price do I want to convert the leaps into. Well, right now, SOFI is down 7%, just updating you guys. But I think ServiceNow is in a very strong position. I don't expect uh, I don't expect there to be any problems. They came up with a fantastic earnings, market like their earnings. And I think with software names, they are so beaten down that any news that is not the complete death of software, they kind of are getting rewards from there. Now, I think right now, if I'm not wrong, the NASDAQ, we're already down over 10%. Are we? From the highs here, 747. All the way down, we are down around 11%. Right, we are down around 11%. So NASDAQ is in correction territory. We haven't reached bear market territory. Bear market territory will look more like 20% down, 20% drawdown. 20% drawdown, we are looking at, what is this? 597. Do I think we will go to 597? I don't think so. You need to have something drastically worse happen. I think sometimes we need to ask ourselves, what is the catalyst that can bring us down to that area? I think if you are talking about on a technical basis, what could happen is that if we see another negative day today and we close below the 50% FIB, we should retest the 200-day moving average, which is the confluence level of the FIBs over here at 645. So that would mean another decline of around $30. $30 is like a 0.5%. Around there. That's what I'm expecting. If we are seeing this, that's going to be around a 13-14% correction. It's not yet a bear market, but I think the 200-day moving average plus the FIB here should give us some decent support. All right, 2 minutes until market opens. Yeah, 2 minutes until market open. I just realized, yeah, hmm. 1 minute until market open. All right. We are getting ready to see what happens when the market open. The losses are accelerating for SoFi. I did not think I will be seeing this quarter. We're down another 9% on the quarter. So this is exactly the same thing that happened last quarter. Around we were down 9% last quarter. Now we're down 7%. All right. Markets are opening soon. Let's see what happens. All right, markets are open, and if you're looking at this with me, the S&P is down 0.2%. S&P down 0.2%. The Qs are up around 1 basis point. I think there's a lot of volatility in the markets today, largely because of the expectations around the FOMC later. If you saw that report on Citadel, some companies or some Citadel were expecting one rate hike today, a surprise rate hike. The Q's down 0.2%. Everything is down. The VIX is up 3% over here. If you guys haven't followed, the South Korean index is down another 6% today. So it looks really, really ugly. If you look at it on a weekly basis, you basically have a drawdown, nearly a 30% drop on the index, which is crazy. 40%. But Bitcoin is holding pretty steady above the 200-day moving average over here. And you're also seeing Ethereum holding 1900. And I think Ethereum holding 1900 is pretty bullish. You can see 1, 2, 3, 4, 5, 6, 7 weeks of green out of the last 8 weeks. I think this is a good base for Ethereum to start creating. Um, yes, yeah, I think Ethereum's move really is a lot dependent on the Clarity Act. We might see a little bit of a sell-off if the Clarity Act doesn't pass. SoFi at 1530 right now, absolute pain in the markets, at least in the portfolio, sorry, because of SoFi. SoFi is down 9% on the day. Does it deserve to be down 9%? No. Is it down 9%? Yes. So I will likely be buying more. This gap that you see over here was basically what we saw in the last earnings, and I expect that this will be the same thing. So, as I was saying earlier on, someone was just asking me where will I be buying. I will be buying once it touches and confirms at the green line over here. The RSI is down to around 22. It's ridiculous. Okay, Nvidia, let's see. Bitmine down 0.8%, Hood down 0.25%, Zeta Global up 2% on the day. I think Zeta Global is one of our better performing companies. CoreWeave bouncing off this line, and this has been a relatively strong support. I think if we lose this, I don't know where we are going down to. It'll be like price discovery on the downside. ASTS up 2% today, fantastic. I think ASTS has been respecting this 0.618 line uh, quite well. So let's hope it holds. Nvidia down to 195. We are bouncing off against the 200 day. The 200 day is a really, really strong uh, support for Nvidia. You can see in terms of the RSI, we are also like near oversold levels. So I don't expect Nvidia to go down by too much more. In fact, if you take a look at the last couple of days, even with the AI chips sell-off, you are getting companies like AMD selling off 5, 6, 7, 8, even 9% in a day. But Nvidia moves just a couple of basis points, and that is largely because for Nvidia, a lot of things are already priced in, and in terms of a valuation basis, their valuation is quite fair right now. So when the market corrects, you are not seeing Nvidia take as big a hit. Grab is down 1% on the day. ServiceNow up 0.2%. Let's take a look at what is happening in the other areas of the markets. We have the AI chips sector, Nvidia down 0.5%. AMD, after dropping for the last couple of sessions, now finds itself down just 0.2%. So I think you can say that they have definitely lost the 50-day moving average. The next place I'll be looking at is this gap close at around 360. So I think we can get to 360? I actually think it is relatively possible because this was only in May of 2026. So we are just going back a couple of months. I think the euphoria has uh, kind of I would say come to a relative pause for now. And let's see what happens after they announce their earnings. But I'm expecting this area to be relatively strong support. And then the next area that I'm looking at for AMD will then be closer to the 200-day moving average over here. So I'm just looking at these two levels. Sorry. I'm just looking at these two levels for AMD at 308 and 360. But yes, okay, so if I were to draw the fib from 188, you are getting so okay. I like it every time you draw the fib, you can see the levels more clearly over here. You are seeing 50%. That is the first magnet line over here. Around how much is this? 386. So that is we are looking at 433, then 386. These two, if it doesn't hold the 100-day, then we're going down here. So this is more like a range, I would say, where if you want to add for a long-term position in AMD, I wouldn't be opposed to someone adding in this between these two green lines over here. So sometimes when you look at price targets, you don't just look at the exact point, you look at it in a range. And so for me, that range will be if it drops below here, stays above here, and consolidates, I wouldn't be upset at people adding in that range. Broadcom again down 0.6%. I think what we are seeing is a little bit of weakness. 3 times now, Broadcom has tried and failed to break above the 50-day moving average. That's not a good thing. The short-term trend is definitely down. We want to see this start to inflect upwards. Right now, I am not ruling out another retest of the 200-day moving average for Broadcom. Okay, let's take a look. Let's take a look at what's happening in the rest of the markets. Do we have anything? Hmm. Bought 200 more shares of SOFI. Let's go. Let's go. 1526. Well, 1526. You know what? I can't help myself. I need to buy more SOFI shares as well. I will assess the account. I'll see where I can raise money from. Let's take a look right now. Where can I raise money from over here? Okay, my only concern right now. If I sell off my extra 20 ServiceNow shares that I bought at $97, I could raise around $2,000 to buy more SOFI. That's a good. I mean, 6,000 shares is a very, very healthy share count to have, especially if you think that this can go back to $30, $40. Fantastic place to be. Did well on the $16 puts and the calls sold. So, you know what, Lawrence? The more that I do this actively, the more I think I should start buying calls and buying puts as well, rather than just selling. Because since I'm always on the markets, it makes sense. Kunal, I'll wait until FOMC. Again, yes, I'm just worried about what's going to happen with Kevin Walsh. He is a little bit harder to read than Jerome Powell. So now we are really down 9%. Okay, fantastic. We'll be definitely adding more SOFI to the portfolio. So let's see what happens. Oh, Ardian. I like Ardian. Okay, let's take a look at the rest of the chips play. Qualcomm. ASML, I think this is one of the most ridiculous sell-off I've seen. They were expecting $36 billion in revenue. Now they are guiding for $43 to $46 billion in revenue. And yet we are down. Like earnings came out here at what, 1800. We are now down to 1578. Yep, I think Robinhood and C Limited should be doing well. As well, I think they would. I think in my commentary earlier on, I also did say that I think Hood should do better than SoFi, largely because of prediction markets. I think the World Cup will be very big for prediction markets. That's going to be a huge revenue driver for them. Qualcomm down another 0.6%, Micron down 0.5%. So I think we are not seeing a huge sell off like the last couple of days, at least not yet. We are seeing the sell off start to slow down a little bit. But I think if you look at it, the more medium term momentum is actually still neutral. So could the sell off continue to accelerate? I would think so. They are at oversold levels over here. This is Micron as well as the rest of the the sector. SK Hynix, for those that bought during the IPO, I'm so sorry. Right now, it went all the way up to 194, but it's back at 127. SanDisk down over 50% from here. And Marvell is up. Okay, it's barely up. It's like up 0.5%. Okay, what else are we seeing? I think the rest of the companies, I got nothing much. I mean, Corning reported fantastic numbers, fell all the way down. So let's see whether or not you can break past the 200-day moving average. Okay, so infrastructure layer, we get Google recovering from their earnings. If you manage to buy the dip, 314 was a fantastic place to buy. After all, it is Google. Every time it hits the 200-day moving average, always makes sense to DCA in if you already have a position. Amazon is breaking down past the 200-day moving average, so we are coming back down again. I posted on X recently that a lot of people thought that you missed out Meta whenever Meta was at 685. So for those people who think that you have missed out on Meta is currently at 593. You did not miss anything other than that one announcement that they are going to sell their excess compute. The excitement came in, pushed it all the way up. The question is, at 593, are you going to buy right now, or are you going to wait because it is red? So the thing about psychology around investing is this, right? When it's at 685, everybody wants to buy, everybody says they missed the boat. But now at 592, how many people are buying? Microsoft, I think Microsoft is in a very similar position to a lot of the companies. We are seeing them reject off the short-term 50-day, 100-day moving average, the short to medium-term trend. And I think we need to see a break and hold past some of these levels to get a bit of a reversal. And the only company in the AI race that is up is Apple. Just don't invest any money into AI, have the shittiest voice assistant, and then charge for the hardware. Whoever thought that that would be a winning strategy? Yes, you may. Is SoFi a falling knife? I think SoFi is okay. In my opinion, I think SoFi is a little bit like CrowdStrike. What do I mean? CrowdStrike previously, before the blue screen of death event, they have already proven to investors that they can be profitable, and they can be very profitable, right? And that is why they were trading at the prices that they were trading at before the blue screen event. Now, after the blue screen event, everybody thought CrowdStrike was dead. People did not want to invest in CrowdStrike because they thought that, no matter how good the earnings are, CrowdStrike always seemed to be falling down. But because that was the environment that CrowdStrike is in, and right now you can see that CrowdStrike is starting to turn the corner. They are showing profitability as they have done previously, and the stock is getting rewarded. Now, is SoFi a falling knife? Let me show you the graph over here. If you look at this was just in November of 2025. This is just 10 months ago. We were at $32.73, nearly reaching $33. What changed between November 2025 and August or July of 2026? The only thing that changed is that Trump attacked Iran. That has caused higher oil prices. Higher oil prices means that there is a chance that inflation comes back again. Chance that inflation comes back again means that Federal Reserve might be hiking. And at the start of the year, we were expecting 0 rate hikes. Right now, the base case assumption is 1 to 2 rate hikes. So the reason why SoFi is a falling knife is probably because you bought in the last 10 months. And then if you bought in the last 10 months, you feel like it is a falling knife. If you were buying with, so Frank, it really depends on where you're buying. Most of my buying of SoFi happened below this green line over here. So if it happened below this green line, yes, it has fallen quite a bit today, but it is still more than a double for me. So yes, painful, but I don't feel like it is a falling knife. This entire thing can be purely attributed to the rate environment that we find ourselves in. Do you think they should announce a buyback program? I don't think SoFi should be announcing a buyback program right now. I would prefer them to reinvest into big business banking, to what do you call that? SOFI USD. I think maybe once growth starts to stall in this area, then yes, I would say a buyback would make sense. Now, at the moment, I don't think that we are close to that range. SOFI is at $15. Okay, you know what? I am going to just buy 200 SOFI shares here. And I'll find a way to raise capital later. Okay, well, the price actually moved quite fast. Okay, so do I think they should announce a buyback? No, I really do not at the moment. Yeah. So to answer both questions, is SOFI a falling knife? No, I do not think so. They have proven that they can actually scale. They have proven the markets will recognize their business in the correct macro environment. We are just not in the correct macro environment right now. So I think in terms of SOFI's fair value, I would say between $18 to $25. I think right now it's a little bit of an overreaction by the market. Fair value, if these assumptions actually hold, $18 to $22. Yes, I will be covering Zeta's earnings live. I will also be releasing the video on Zeta's earnings and Grab's earnings over the next couple of days. What happened today? The same thing happened. SOFI did extremely well. Markets not recognizing it. Some of the analysts are worried about their CET1 ratio falling to 19% from 22%. So this 3% fall, according to one of the analysts, is very fast. So he wants to have a better understanding of what's happening, right? He doesn't understand how people grow their business. He doesn't understand how that analyst at that last question and the way that it was framed really pissed me off at the end. But basically, SOFI, strong revenue growth, expecting 2 rate hikes, but still going to deliver 60 cents EPS. That is the summary. And people are unhappy. Analysts are unhappy because they are afraid that rate hikes means that SOFI will have to slow down. But I just want to say that SOFI's business did not slow down. It's just that the sentiment changed. And this is exactly what you see. April 2025, we were at $8.60. Within 6 months, we 4x'd. Why? Because in the 2 years prior to 2025, 22, 23, 24, 3 years prior, during the rate hiking cycle, SOFI stayed compressed despite the business performing. Once we started to get a little bit of relief from rate hikes, within 6 months, the company grew by 4x. I think something similar could happen this time around as long as Trump is doing Trump things, attacking Iran, then I would just say that we are going to stay between this range, $15 and $19. Although I think fair value should be around 18 to 22. Okay, real fair value to me is 30. But the reason why I say to me real fair value is 30 is because I am pricing in financial services growth, I'm pricing in tech platform growth. But if you're just looking at the markets should be assigning a value of SOFI between this range here, $19 to $22. But I think what is likely to happen with the fear, and markets usually over exaggerate, we might end up basing between 16 and 19 instead. Yeah. So I think the trend is showing itself, right? When we have fears over rate hikes, we are going to see things like this. And we are getting the same thing right now. Fears over rate hikes. We don't the issue I have is that in the past we actually had aggressive rate hikes. And SOFI was still growing. Now we don't even have rate hikes. We just have fears of rate hikes. Which is why SOFI has been basing this way. So I think this is where we have to be a little bit the initial drop off here to around $19, $20. I thought that this was a very healthy pullback. And I thought that once the earnings came out, you can actually see in first quarter's earnings, after first quarter earnings came out, we actually went all the way up. and retested this range over here. So I thought that was a healthy pullback. Like you 4x in 6 months and then to have a 20-30% pullback, that is actually pretty healthy. But what has caused this ridiculousness that we are seeing over here is that because in February, sometime around here, we got Donald Trump attacking Iran. And since then, the fear of interest rates basically caused us to do nothing for the last, I would say, 6 months. And this is the exact same pattern that we recognized back in 22, 23. The difference is that instead of fears of rate hikes, we had actual rate hikes. But then in 2025, this is what you're seeing. This is what actually happened after the fears of rate hikes went away. After the fear of rate hikes went away, we actually saw towards the end of 2024, we started to climb all the way up to $18, where we are now. Came back down again. 2025, we basically did a 4x in a matter of 6 months. Nothing has changed. SOFI has become stronger. We are adding over 1 million members every single quarter. Revenue is at $1.2 billion. On an annualized run rate, we are expecting $4.8 billion in annualized revenue. EPS expectations around 60 cents, perhaps 61, 62 cents. And I think, and I'll give you, I'll leave you with this. If you are expecting an EPS of 60 cents, and the PE ratio of SOFI normalizes to 50 times. Why did I say 50 times? Because that is where they were trading at the start of the year before the Iran war. After the Iran war, they were 30 to 40 times. But at 50 times at EPS of 60 cents by the end of the year and 50 times PE, you're assuming a price target of around $30 by the end of the year. If you are looking at a 40 times PE, which is where we are trading at before this recent fall off of earnings, then you're looking at what, $24. So I can actually feel comfortable with buying SOFI at these prices, because if we just restore multiple and SOFI does what they say they will do, which is a 60 cents EPS, then something has got to give. Either the market says that you continue doing what you're doing and we are going to just pay less for you, which is possible. We have seen that happen for 2 years. Or SOFI does what they are going to do and the markets maintain the current multiple, which they were awarding SOFI pre their Q2 2026 earnings. And if we get a 40 times multiple, that would mean a price target of around $24 by the end of the year. So you are looking at SOFI getting to $24 to $30 by the end of the year. And if that's the case, buying at $15 here really shouldn't be a problem. I've added my 200 shares at $15.10. Just got assigned. So I need to sell shares. I need to raise capital somewhere. Otherwise, I'm a bit over collateralized over here. Let's see. Yeah. So my calls are getting hammered down 20% in this account. In the big account, and yeah. Thankfully, I raised some money before this. So if you actually, in my previous video, I was talking about how I put $50,000 aside for CoreWeave. So, I mean, that is doing pretty well at the moment. Yeah. CoreWeave is down 7%. My portfolio, yes. Okay, my CoreWeave average over here is $69 in this other portfolio. Let's see. Yeah, the SOFI covered calls expiring 14th of August is worth 2 cents right now. I could definitely close it out and pay back the $200, but I mean, what will I do? I can't sell another covered call at these prices, so I'm just going to hold it. Yeah. I like to sell calls, buy puts with the premium. Yeah, you know what? I should be less greedy and I should start doing that. I always want to keep the premium for myself. And on days like this, I feel like I kind of screw myself over. So I should start doing that, at least on a part of the portfolio, right? Even if I want to be greedy. So I have like 13,000 shares of SOFI and around 10 leaps. I will probably like sell covered call and all 13,000 shares, but then in terms of puts, maybe I'll use 60 call contracts, 60 covered calls worth of premiums. That's what I mean to buy the put. Maybe I should do that. My calls down 60-70% expire in January, writing it off as a loss. Yeah, I mean, I think January, depending on the strike, you can see SOFI right now down to $15. We are down 10.5%. Absolutely fantastic. Let me go and buy some more. I'm going to wait for the IV to normalize a little bit. Historical volatility is at around 43%. We are at around 60%. Now we're pretty close. We are pretty close, but I will have to look at the position. Right now, yeah. I think I really have to relook at the portfolio. This is how I end up getting, like for me, SOFI is a sleep well at night stock. Yeah, definitely. I think what we are seeing right now is a broader market sell-off, and that has to do with fears around the US-Iran conflict. So naturally, we are getting this kind of, so there's a confluence of things together. Like today really wasn't a good day to report. You have Iran striking Jordan just before their earnings. You have earnings, which is fantastic, but now they are baking in the base case of 2 rate hikes. So although they raised their revenue guidance, they actually maintain their profitability guidance, which, as Kunal pointed out, would actually mean that they are compressing margins, which is expected because Anthony Noto has already said this on the Basis Points podcast before. So if you see, we have a little bit of alpha that the analysts didn't have, right? We already know that Anthony Noto was planning this way before the earnings. So that's number one. That's number two, sorry. And then, of course, the third thing also is the FOMC meeting that is coming in later on. I think people are worried. If you read the Citadel polls yesterday, let me see. Here. I think this is just, when I see things like this, I really, sometimes my friend asks me why am I always so pissed off at analysts, and I'm always talking shit about some of the analysts. I'm not saying that all analysts are bad, by the way. There are good analysts, but there are a lot of analysts which are, I don't know. I don't even know how they can get hired. Let's just put it that way. And this is not even the analyst is bad. This is, to me, a bit unethical. Like there's no justification for rate hikes right now. They are just playing on the fear of retail to release this article. Hopefully retail sells and they want to buy. That's all. So Citadel Securities expect the Federal Reserve to raise interest rates this week, a surprise move strengthening Chairman Kevin Walsh's credibility in the battle with inflation. A quarter point increase on Wednesday would reinforce Walsh's repeated pledge to restore public price stability, while showing policymakers no longer rely on signaling every policy move well in advance. So I feel like it is detrimental to public confidence in the Federal Reserve if they do that, because I think what this article misunderstands over here, purposely or not, is that the markets trade the way they do because they can trust the credibility of the Federal Reserve. And they are saying it here as if it is a bad thing. No longer rely on signaling every policy move well in advance. The point of signaling the policy move in advance is so that the markets can start to price that in. You get a little bit more stability in the markets. If you just shock the market every single time, then that is going to be a risk premium that is going to be added to the markets that will then have to be priced in. So I really do not think that they are going to do that. I think this is just fear mongering. I think this is, I mean, I will be completely taken aback today if we are getting rate hikes. I think, do we see rate hikes coming? Different question. Maybe in September if the oil crisis continues. Right now, $84 per barrel, nothing warrant rate hikes. Yes, there's a 6% increase today because of the conflict reigniting. Fine. But to say that oil at $84 deserves a rate hike, I think that's ridiculous. I'm so sorry. It is ridiculous. No, SoFi never went ahead with the lawsuit against Muddy Waters because Muddy Waters also stopped after a while. Citadel, Crenamore, yeah, I mean after the last time they did what they did, wouldn't be surprised. Yes, and Muddy Waters' case should not be valid already with this Q2 earnings. Definitely, nothing that Muddy Waters said actually came true. It is what it is. It's just fear mongering, and I absolutely hate it when analysts and when companies come out and fear monger like this because there are a lot of retail investors who are not degenerates like us who are here 3 hours in a single sitting to listen to the entire earnings call and to watch the market open and to follow the FOMC and everything else that happens thereafter. And these people, they rely on news that they see. And when you see the headline news like this, Citadel expects surprise rate hikes. What are you going to do? You're likely going to panic sell. But I don't think I think Kevin Walsh is a Federal Reserve chairperson that will want to cut rates, but he's not someone, from what I understand, that likes to print money. So which means he's going to try and prevent a recession. And he can do that by cutting rates in future once we get a little bit of price stability when it comes to inflation. But once you are in an inflation, he's like the tough love, suck it up, get through it. If you lose money, some businesses have to close, purging the economy. That's all par for the course. Sarah Eisen is covering this exact thing on CNBC right now. Let's see. All right. So the argument on CNBC right now is that if he hikes rates and they actually get financial conditions to tighten, that's how you fight inflation. My problem is that for every time you cut a rate, it takes 6 months to pass through the markets. And if the inflation right now is largely due to Donald Trump and his war with Iran, then it is not something that is structural. You end up hiking rates at a point in time where the underlying economy, if I'm just going to pull up the article right now, the tech layoffs this year up to July has already been worse than 2025. Let me pull up the article. Tech layoffs 6 year to date, more than 2025. I should have saved this a while back. Sarah Eisen is half being cycled by the Citadel call that she heard. But I think that this is all fear mongering. If you ask me to put a bet on it, if I have $100,000 now, and you ask me to buy before or after, because if you're buying before, you're expecting no cuts. If you are buying after, you're expecting no hike. Sorry, if you're buying after, you're expecting a hike and the markets to drop. My money would be on buying before. I don't understand what this comment is saying. Something about providing questionable loans. I think SoFi has just shown that none of their loans are even close to being questionable. So it's just the market pricing in all of these things at the moment. I think to me, the actual the initial reaction was the most valid. Sorry, you saw my fantasy football. I was just trying to see how accurate Claude is in terms of understanding fantasy football. All right. Anybody plays FPL over here? Just checking because I know I got a largely American and Singapore audience. So I'm just not too sure how many people play FPL. But with that being said, so to answer the question below, what happens when you're providing questionable loans? $12 soon. If $12, I will buy more. I would never thought I would be buying SoFi at $12 again. If SoFi reaches $12 with these expectations, I am buying more. What will you sell calls on Zeta? I'm thinking of 25. I haven't really looked at selling calls on Zeta. I feel like Zeta is a little bit of a coiled spring. So I do not want to take too much of a risk on that position right now. Yeah. But I think generally what I'm looking at is actually this article over here. Tech layoffs tracked in 2026. All of the job losses across this, you can see we are more than halfway through 2026. Layoffs in the tech industry last month, 114,000 job cuts. Basically, we are okay. Layoffs seem to be moving at a faster rate than last year. Over $245,000, $245,000, 245,000 workers in tech were let go in 2025. Right now in 2026, as of June, we had 170,000. So we are on pace to reach around 340,000. So in July 2026, we have Monday.com laying off 20% of its workforce, which is 630 people. Visa cutting about 2,600 jobs. Patreon laying off 20% of its workforce. Uber laid off 10%. Microsoft laying off another 4,800 jobs. I mean, that itself is already more than 10,000 jobs being lost. Added into the number, I already feel like the economy is not in the strongest position. And if they are hiking, I don't think it's going to look pretty because if you hike and stock prices absolutely fall off the cliff, I think if we hike, we will see the Nasdaq and the S&P basically touching the kind of support line. So I would expect S&P to drop to maybe 1720 to 710, 720 around there. Over here. And then I'm pretty sure if we get a hike today, we are going to see the Nasdaq all the way down at 645. So why did I say that is a bad thing? Because naturally the stock market is also in a sense a self-fulfilling prophecy. The stock price falls off the cliff because the Federal Reserve hike rates. Shareholders get absolutely pissed off, ask management, hey, you should be optimizing for profitability. What do the management do? They end up firing staff. When you end up firing staff to raise profitability, you actually permeate the recession yourself because the people who are fired to raise profitability for these companies, they get lower income, they spend less, the economy starts to contract, and you're in this whole shit show right now. And I think this is not a point in time where Trump or the US can afford to take that kind of risk. Because honestly, what is the worst thing that can happen? Okay, inflation is at 3%. I think that is a much more manageable risk than a recession. Fundstrat says no hike, but Q2. I think that is a more reasonable take. I think the expectations of a rate hike is a little bit hyperbolic. I think it's meant to generate some sort of fear, some sort of reaction, which I don't think is necessary. But let's see how it goes. Now I've been on for 3 hours. I'm gonna need to take a break. I will be back later on, and we will go for even longer. We will be covering Hood earnings. We'll be listening to the call. I will probably I depending on what time I finish gym, I'm gonna just take a short nap. Then I'm going to head to the gym. I'm gonna come back and we are going to do everything. All right. Thank you for being here. The markets are red. Everything is down 0.5%. I have bought more SOFI. I will sit down and do the math around SOFI to let you know what prices I'm buying at. But with that, I will see you tonight. Just pay attention for the notification. I'll be putting up the schedule on when I'll be going live. All right. See you. Thank you. And I hope your stocks do not go to red. I can't say stay green. It's not green today. Just hope that they do not go to red today. All right. And I'll see you guys later. Bye.